Are we good? I think we should be good, yeah. We should be good. Are we good? I think we should be good. Hit the link and we're on our way. Then we will get caught up real quick. Shout out to the planning though, right guys? Like, you know, give me a second and then we'll get going. Right guys? Start talking my shit. Just leave a little chat open. Okay, okay. Here's the Discord. Planned and prepared. Too easy. Too fucking easy. Hopefully this music's allowed today. We should be good. Yeah, even made some notes to come back, right? We were talking about all this, right? Like, this is the trade that we took on the last stream. Look where we are. We got the first TP hit. Got this thing hit. Got this thing hit. I'm gonna start the smaller one here, right? Like the real third one is up here. The next main TP. This one. Yeah, I mean in terms of where we left off with the juice box though, pretty easy, right? Pretty straightforward. The first thing we talked about was retesting the previous week Valley Area low. Bing! At the golden pocket again. Too easy, shout to the math. Yeah. And you could have taken like the failed auction of this value range, right? At the end of the day. Kind of just like this ding 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 ding. Which we also talked about. Yeah, so far looks like we're kind of just mathing up here, right? We kind of failed to go lower from this volume node, and now we're flipping the top, like on the higher time frame. We'll do it on here. And I just flip this thing onto the 4 hour. I just failed to go lower and just flip this zone so far. Now we're making a little bit of a wedge. Can we continue moving up? We're not. We're not. Market is closed tomorrow, so technically it's the weekend. Feels good. You know, some of this garbage. Do we need this anymore? Not really, right? We're all aware of what's going on there. Also, in terms of the short opportunities, if you had taken both the shorts we talked about, you would have been in it, right? This one, worst case, you got stopped out break even if you didn't shave. This one, you're still chilling right now. So shout out to the planning on those as well. But is it, guys, this mirrors are too easy. I mean, actually. I swear this trading shit is actually too easy. Get rid of that. We're gonna update our levels. Can I move that? Interesting day in the overall market though. Technology sector was getting beat down, getting their ass beat. A lot of rotation though. A lot of their shit was flying today. Thought that shit was flying, boy. I'm so tired though. Oh my god, I don't think it's gonna be a particularly long time sitting here. I barely slept last night. Barely. Also took some of this data. Update the levels first before I forget. 61793. The question is, what do we do after? What do we do after this? 60807. Yeah. Okay, cool. And with that, yeah, what else was I gonna say? Fuck. Lost my train of thought. Damn, I'm so stupid. What was I just thinking? Whatever. Whatever. When does it stop trading? 15 hours. Like noon tomorrow. Okay. This shit is still sending. Interesting. Kind of curious to look at the spot volume right now. Because we were talking about how the open interest would look like when we got up here. And on this first candle, like everyone closed out. It was like a full 100% retracement of the whole thing. Let me just see if I can screenshot this in a second. Or not. Or not. Or how do you even screenshot this keyword? I don't even remember. I think it's like this, right? I believe so. Yeah. Yeah, so this was the open interest that I was talking about yesterday, and it came right back by the time we got that first high. So that's why I'm curious to see how spot is looking right now. Okay, okay. How much is that? Okay, nice. Nice, nice, nice. I'll be curious to see where we go from here. There's the higher time frame stuff. All this data looking. Boom, boom, boom. Hmm. Yeah, we'll look at the order book and we'll look at the higher time frame liquidity above us. We were talking about this yesterday, right? Like, or not yesterday, but last time we streamed. Like when we were talking about this trade, how this could have potentially been like the beginnings of a high time frame move. Kind of looking like it, right? Like pretty impulsive too, off the low. Why isn't it? Now we're just consolidating up here. I mean, if you are bullish, I guess this is what you want to be seeing to begin. Question is, how are these upper zones looking? Hmm. Probably quite the retrace. Boom, boom. We'll give it some more thought in a second. Hmm. Okay. Pull that later. Boom, boom, boom. Mm, 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 mm. I'm so stupid, it's crazy. Crazy. D5, D8. Hmm. Did they add more? Oh, interesting. They added some new data on CoinGlass. Interesting. More CME data too. Interesting. Anyways. Anyways. Hmm. What's the funding? Interesting. Interesting spot. Like it's the weekend. Maybe we'll see some volatility, but not too sure about that. I'm trying to give thought to this, right? Like I don't know. I don't think we're done going lower on the higher time frames. I'll say that. I'm just trying to determine like, well, what I'd need to see to like be convinced otherwise. I would be like flipping this zone, yeah, like way up here. Probably. Because anything between like here and there, it's like, you don't really know what's going on, right? Like, are we just gonna like do this? Are we gonna like hit up these moving averages? I'm going to like the higher imbalances and like lose the value area high, etc., etc. And then just end up going lower anyways. Realistically though, I mean, hard to say. I guess we'll see how the flows are looking as time passes. Wonder what the sentiment is like. You know, it would be really cool to work for like a company like Google or Meta, like any company that just has a shit ton of like user data online. Because the sentiment data in trading, I find it so hilarious, but also interesting. I can only imagine how insightful it would be to have like all of the internet's data to be able to like think about stuff like that. What should we watch? I guess we all know what we're watching, right? It's the kind of the main zone. Does this get flipped? Or not? Or not? Or not? How's that lower time frame looking below us? $607. What would that be? Interesting. Basically the answer is the value areas, right? Like up here and here, like the two main areas of interest for now. Anyways, we'll chill. We got our alarm set. Don't need to worry about this shit. Already in the trade. Already got the two main TPs hit and the small one. Now we are just chilling. Thing is, I haven't added to the short yet. Like added back. Like these are like perfectly valid opportunities to do so. But I'm not trying to fuck with my average price right now. Just for the next like week or so. Yeah, until like the 9th. I'm gonna be relatively busy. So I don't mean a scenario where I like aggressively add it to my shore over and over and like walk down the entry needlessly. And then it gets like stopped out. And we start to reverse and I don't get a chance to get back in because I'm busy doing whatever. So yeah. That's something else we need to look at, y'all. Maybe I'm baited. So let me stand up. Goddamn. Try to sit my ass down, boy. Boy. Might just watch one of those videos and chill, honestly. I'm not trying to do any like... I don't want to be thinking too much right now about my own ideas. rather just hear other people's ideas right now and just kind of that thought. Too tired. Oh, I'm too tired. Oh, so I haven't been trading the alts really lately. I was looking around some of them today on the higher time frame, and there's some pretty interesting trades setting up there. Might have to go dabble in some of these things. Bum, bum, bum. Mhm. Bum, bum. Oh yeah, I forgot. Like CME started trading on the weekends nowadays. Did you guys notice that? We got CME trading on the weekend. Oh, the volume has been so little so far. I know it's the same story every week. Like, look at this. I'm hungry, but what? Hmm. Interesting. I'm in a Palantir trade right now. I'm like way lower. Just thinking. I mean, I guess we'll see how it goes on Monday when we resume. Because there's a world where I might just let it go and like just fucking. In the scenario where this keeps running, it ends up being a massive juicer. We'll see what next week comes along. It's really shaping that thing, so we don't need to worry too much, but should we leave it on? Bum, 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 bum. You You know, the other crazy thing about trading a lot of this traditional finance stuff is that's way better than crypto is the fees. The fee difference is insane. Okay. What did Intel end up doing? Down. I was hoping it's gonna break out. I had like a position in this. I was still going, but it got stopped. The render got stopped out today. And it feels bad. What would have been nice if it just retested this level and just went right here when it did the pullback. Feels bad. Oh well. Oh well. Did it stop or what? Okay. Don't need to keep watching that for now, right? Also, yeah, okay, I have an alarm ready. Because I'm in a hype trade too. But I have an alarm like to add here. If we like get above the high. We'll kind of leave that doing that. And I think we can chill. I think we kind of got caught up on everything. More or less. Okay. Okay. Oh man, I'm so happy tomorrow's a holiday. So goddamn happy. Get to sleep in. Just a little bit, nothing crazy, but after yesterday, goddamn, I need it. I'm so tired. Tired. Could have been grinding so goddamn hard. That's the problem. Oh, grinding so damn hard. Okay, should we watch one of these Thangity Thangs or what? I guess the question is, which one of these seems the most interesting? Are these synced? I don't know. These are all like. Maybe we'll watch the Lance one. Thing is, I feel like I'm already gonna know because I'm already familiar with this guy's content, so I feel like whatever he's about to talk about, I already know. This is some like hyper niche strategy. I guess I'll have to watch it one way or another anyways at some points. This guy's just talking about like the Weinstein stages. My problem with some of these prop firm traders is that I was watching some channels talk about this stuff, and like there's like prop firm trading isn't like, there are people that game the system. I realized more than I thought. Like I thought they were doing it when it first came out, and now that they've added the regulations and like all the different rules in the accounts, that people couldn't like game it as much. But they're like trading strategies. Which then the account has like a probability of survival. So you're taking on like more risk than you usually would. And essentially the way the math works out over like a large enough sample size is that like the accounts that get zeroed out are compensated for by the accounts that you're risking more with like the potential to blow up. But since like the account fee is fixed, you can like kind of scale it up. So somewhat interesting. But like not viable, right? Like that's not really, it's not real trading. Like you're just, I mean, I guess it's real given that environment that they're allowed to do that in, but like if the economics of it change in any capacity to make that no longer viable, then like you're no longer a profitable trader basically. If that's what you're doing, which I think is stupid, whatever, but definitely gonna have to reinvent yourself if you don't really know what you're doing, and that was how you were making money. If that does get addressed. Boom, 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 boom. Boy. Oh my god. Making a massage shoot and I'm so tight right now. My upper back is, it's because of how I've been using my desk here. My other setup with my like other monitor. Like the table and the chair are not matched correctly. My shoulder was like elevated all day. Now like that whole spot is like tight as fuck. But even more so after the gym. I did hella rear delts today. Trying to grow my shoulders, boy. Trying to get fucking boulder shoulders. Boy. Only thing that sucks is this injury, man. I can't like do any heavy overhead pressing. And even like stuff elevated above 90 degrees doesn't feel the greatest. So I can't, it's not easy to do like flies and whatnot. We're trying, we're doing what we can. Okay. Enough of me yapping. Why did it?
The next market.
Yeah. I haven't finished reading this book yet. Like the new Market Wizards. I've been reading so much stuff. And I've been doing a lot of my reading at the gym when I'm like moving down doing cardio. But I don't want to read this book and like not be able to like take notes. I've been reading like a shit that's not as... I'm trying to study it, we'll say that. What was I doing? Yeah. Now, I'm curious where NASCAR All Out is at. I'm curious if you read this. Like from skimming through it. So many of these people all started by like shorting low caps. Okay. Look, apps. Do we position this? Do something like that. And then that should be good. That should be good.
Wizards book with $100 million plus of verified profit.
The best trade of my career, I very much applied this simple system, combining some of these concepts, and then I just trailed it prior bar lows, and it just trended right back. The beauty of this is going to apply to every product and every time frame. I'm trying to get the odds as high in my favor for a bounce. I'm trying to make the reward as big, and then...
Welcome Lance Breitstein to Chart Fanatic. On this episode, he goes through step by step so that you can follow along and look to implement this into your own trading.
The way I process my trades is at any given moment in time, I am constantly weighting all the factors dynamically. I would say rate of change is one of the most important factors I'm looking for. So we can build this same framework and the same theory using meaning there will be times where sentiment is priced for euphoria and nothing can ever go wrong, and there will be times when sentiment is priced as if nothing will ever go right again. And the truth is,
No matter the asset class, this strategy is for you. Learn from a true professional trader firsthand for free.
the beauty of this is you can say, oh wow, I can make 10x my money as long as the US doesn't default. So at a 99.99999% win rate, you can make 10x your money. In this type of chart pattern, that as a long would be like trade of the century, because so many people that are taking these paper cuts or are not finding effectiveness in these strategies, it's because they're playing the chart that they think looks like this, but it's really going up and down, up and down, up and down, and it's really grinding. One of the most common mistakes people make is
Welcome everyone back to Chart Fanatics, the go-to channel for all of the very best strategy and concept breakdowns of some of the very best traders in the world. Talking of which today, we have a phenomenal trader back with us. We did a Words of Wisdom episode in January, and in the same year, we've been very
from
blessed
that
to
little
have-
intro, seems like he's just gonna talk about like blow off type moves in either direction.
Chart Fanatics. He has actually over $100 million in verified profits. He's going to be in the next Market Wizard series. You already know who it is. It's the one
We'll see.
and only Lance Breitstein.
Riz, always happy to be here. So happy to be back and now doing Chart Fanatics, which I've been quite the avid consumer of. And so for the audience today, not only do I have a trade, but more so what I want to do is teach the audience how I think and show them how I build these frameworks and these systems for not just one strategy, but how do I think and analyze the market structure and the price action for any strategy so that they can apply this and make it their own in a way that will lead to success in any product, any different strategy, whether it's continuation or mean reversion. And for me specifically, we will be focusing on mean reversion or the capitulation style trades that I am probably most known
Okay.
for, thanks to the good old Chat with Traders podcast back in the day. So the premise I want to lead with is this: markets are extremely efficient. Markets are extremely hard to beat, and most hedge fund managers underperform, and most traders fail. And my base assumption for almost anything is that the starting price that we see stocks or any product trade at is the right price. And with that assumption in mind, you then need to ask,
You know, like I don't like how he's framing this like in this manner already. Like, for instance, the hedge fund point or fund point is like irrelevant, right? You can't compare a solo person trading versus this like massive financial entity. We can just do whatever we want, right? Just fucking buy any name at any moment we want. And it, like, in terms of our account size, we're not gonna just move the entire market for trading anything that's relatively liquid. And like, there's no like rules we need to follow, right? Don't have our portfolio with like balance in a certain manner, blah blah blah. And you're working on like a delayed manner, like ideas have to be like reviewed, approved before you can even do it. So some of them are just sitting here looking at a break on the chart and thinking, oh, I'm buying this today, right? Or at least not once you get to like a certain point of money. Because if you're wrong, you lose too much. The slippage gets too crazy. What was it? There's a couple of the ones on Bicket. The slippage on them is ridiculous. Ridiculous. There's like no volume. Anyways, let's get back to this thing.
ask oneself what might lead to a situation where we're out of equilibrium. And so anytime in trading, the concept that drives every single decision you need to make is expected value. What is expected value? Expected value is your win rate times your reward if you win, minus the odds of losing, which is generally 1 minus the win rate, times what you risk if you lose. And so with all my trading, I try to think about, why might this be out of equilibrium? Why might there be something with positive expected value here? And to do that, one of the things we can focus on is mean reversion, or of course continuation. And so for this, I'm going to be solely from a perspective of mean reversion and why might something reverse the move it's made, and how can we take it away from a random coin flip, right? The whole analogy of, if I flip a coin, it's going to be 50-50, heads I get $1, tails I lose $1. Nobody's making any money except between commissions, fees, everything else. In fact, you're losing in trading. And when I think about this framework, you can start to come up with some ideas and some logic, and that's exactly what we're going to do now. So I would ask the audience to think, if a stock were to go down 1 penny, say the S&P goes down 1 penny, is that necessarily enough to incentivize someone to buy that that they otherwise wouldn't have wanted. Not really, right? The S&P is extremely expensive if you're buying SPY or something, and it's not really going to incentivize that. So the first variable I would say is the size of the move. Size of move. And now, if all of a sudden the S&P 500 didn't just move 1 penny, but it moved $10, $50, $100, in the case of SPY, all of a sudden that might entice people to buy. So the size of the move is a factor that matters. Now, the other question I would pose is, okay, if the S&P were to move, say, 5%, that might be appealing if that percent move is over 1 minute or a second. It's going to be far less appealing if the S&P moves 5% over a year. I don't think anybody on earth is going to say, oh, wow, I would want to short as much SPY as possible if we went 5% higher over the next year. Vice versa, I don't think anybody would say, I want to buy as much SPY as possible if we went down 5% in a year. So that time frame, the speed of move, that's going to be our second variable. So now another thing that's going to affect whether we want to buy this is, of course, is there the presence of news? So if something fundamentally has changed, then we might not want to buy it at a certain price. If all of a sudden it turns out that the quantum computing stocks, for
I was
example,
just yapping right now, right?
do their magic and quantum computing works and it's solving stuff, all of a sudden that news would be really huge and change the.
Whatever. I suppose if you're not like, if you're new to trading, I suppose,
Right?
sure, this is like quite informative, but I'm just sitting here like just falling asleep, right?
Versa for the quantum computing stocks. If all of a sudden it turned out that quantum computing,
I think most people that have been
that is a fundamental
trading
shift
are
in the value
aware
of
of
the company.
basically
So when we're thinking about meter version, we need to be aware, was there a fundamental change
capitulation
in
and
that
the
actual
move,
equilibrium
blow
price,
off
right? Because
moves,
we're trying
right?
to find stuff that's moved away
All the
from that
reasoning and
equilibrium.
logic
And
behind
if,
it.
the fundamental value of the company has changed, and all of a sudden the equilibrium is changing as well. Another factor we can consider is how many days has something gone up or down in a row. So I think most efficient market theorists would say if something has gone down many days in a row, it's still an independent probability. And they would say, okay, at any given time, it's still that coin flip. I would say from experience, and I think most traders just know this intuitively, that is absolutely not true. If the S&P is going down 3%, 3%, 3%, 3%, and it's doing that 8 days in a row, the probability that it's going to go up on the 9th day is by no means still 50-50. That coin flip, the more days in a row you're going down, or the more days in a row you're going up, that coin flip starts to shift much further in your favor. So number of days in a row we're adding to our list.
Yeah.
Number of days in a row.
Hey guys, before we get into this incredible episode, I want to say a massive thank you for all of your support so far on both Words of Wisdom and Chart Fanatics.
We have an
You've
indicator
grown
for that.
immensely
I
and
think it's on
still the
this
fastest
chart,
growing
right?
channels in the trading industry. Now, a way to give back to every single one of you, if you want profitable strategies completely for free, go to chartfanatics.com.
The thing is this
links in the
one.
description, put your email in, and every single week we will send you a free PDF with a profitable strategy of the guests that we host. As well as on the website, you can go straight there and you can go through the library of strategies completely for free. Just input your email. On top of that, we launched a Chart Fanatics free Discord community that has already over 10,000 members of traders across the world. We have our live traders from Chart Fanatics Live in there. I'm documenting every single one of my trades in there, and we have exclusive discounts, massive giveaways, and so much more.
This
just to give
guy.
back to every single
Where's
one
the
of you
skip
to get
button?
updates on every
Why isn't it-
episode and things that we are bringing to this industry that's going to change it forever. But for now, the links for that are in the description. Let's get into this episode.
Now, like I said, we want to find stuff that is no longer efficient around that equilibrium. So what leads to things leaving an equilibrium or some level of efficiency is, of course, when market dynamics can't really be a free, fair market, or when there's market structure forcing things in a certain way. So one thing that tends to happen, and we saw this during COVID, is there can be forced liquidations. So there's a lot of big players that are levered, or there's a lot of times when there can be redemptions, or vice versa. You can be short and get margin called, or you can lose the short availability. So there are times when the market structure is forcing price action that is going to leave equilibrium. And if some hedge fund needs to sell hundreds of millions of dollars or billions of dollars of stock, somebody's got to find that buyer that's going to take it. And that clearing mechanism is going to be a change in price. So another thing that leads to leaving equilibrium is going to be forced buying or selling.
Can we skip this? I think we should just skip this.
Why else might we leave equilibrium? I would say that the more experience I've gained over time, now going on 15 years, I would say I've only increased my appreciation for how much sentiment is what's driving stock prices. Even at the time of this recording, we have seen massive moves in Bitcoin. We've seen massive moves in MicroStrategy, SanDisk, Micron, NVIDIA, Palantir. What fundamentally has changed over the last couple of weeks of this filming? Truthfully, not that much, but the sentiment around AI and some of this cloud computing and the growth and the profitability of it is what's changed. And so sentiment can be a huge factor. And there will be times where sentiment is priced for euphoria and nothing can ever go wrong. Then there will be times when sentiment is priced as if nothing will ever go right again. And the truth is somewhere often in the middle. So sentiment is another key variable we're going to consider here.
True.
Now, let's continue to build this out. What would you be more interested in buying in a panic? Would you be interested in buying a $5 million market cap biotech stock with very shady financials that nobody knows anything about and no analyst coverage? Or do you feel more comfortable buying the S&P 500 or Apple or Bank of America or Berkshire Hathaway, that is? obviously, the larger the company, the more diversified and the more stable it is, the more interesting. So we're going to add another variable, which is diversification and market cap. And implied in that market cap is there's some stocks that have a million eyes on them. Stocks like Apple, Nvidia, Palantir, those have a ton of eyes. But then if we go to small cap world, those are far less transparent and far less efficient. It's going to have less attention to them. Another factor to consider is how stable is that specific security? Does it have cash flows that you can link into? For example, most fundamental analysis is based on the present value of future cash flows. So people are trying to find the value of Apple's future cash flows, or if you take something like a bond, like a treasury backed by the US, they're trying to figure out the present value of those cash flows, and it can be a very quantitative equation. Stuff like Bitcoin, of course, is a little bit harder to value. Bitcoin, I would argue, is almost purely based on supply and demand rather than fundamental cash flows. So another thing is going to be how quantitative the security is. Don't mind my leftiness either. You know, some say I'm the devil's spawn, I guess that's what happened there. And so we're starting to build this framework of, obviously, a bigger move is going to make something more appealing for mean reversion. And same with the speed of move, whether there's news, the number of days in a row, forced buying and selling, sentiment, how diversified is the market cap, how quantitative. And so all of this stuff starts to build this framework. And so now with expected value, going back to that, I would argue that some of these variables start to shift that equation in your favor. And so if something very, very boring and stable starts to make a very, very sharp, large move, especially on no news, all of a sudden, I would argue that it's no longer a random walk. That probability of a bounce increases. The expected value also in turn increases, and same for reward increasing, which improves expected value, and the risk is actually decreasing. So now here's the thing. Expected value equals probability, and that needs to be factored by the wins and the losses. So here's my question to you all. Let's say, as a thought experiment, that Apple goes from its current price, and all of a sudden, it's trading at $1. What is the probability of something like Apple bouncing from $1? Assuming no news and no fundamental change. It happens super fast. I would argue that the probability of that is going to approach 100%. And I would argue that your wins, you're going to be making something like, I don't know, 100 times plus your money. And what actually is your risk? Your risk, if Apple somehow panics just as a thought experiment to $1, your sole risk, even if Apple magically ends up bankrupt the next day, which I would argue is like 0.000001, your risk is still $1. So if we were to do this math and know that we can make, you know, literally 100 times plus our money while risking $1, if we go through that math, the expected value, I'm gonna do a color change for this. The expected value is gonna be really, really big. So the other thing that I want to point out with this example is something magic happens in this example. Because we're going to the downside, we have this lower bound. That lower bound of $0 is actually amazing because it's the most you can ever lose. And the difference in shorting is there is no lower bound and there is no upper bound. Shorting, of course, you can lose infinity. Something can go from 100 to 1,000 to 10,000. And even if you want to say, oh, that can never happen, we've seen that in small cap world. Some crazy prints happen that really can blow up traders. We've seen stocks do some crazy, crazy moves. Even IPOs like Circle this year. So to say, oh, something like that could never happen, obviously, yeah, okay, saying something's going to reach 100 million or something is a little hyperbolic. But my point is, there's a structural difference in shorting a stock versus buying a stock. So for this framework, we can even add buying versus shorting. We can add lower bound of $0. And what we're doing here is we're building this framework of how to think. And once we've built that framework, I like to start to then test it with some real world examples. So now we're going to build a framework with,
I mean, this guy could have literally just
get another COVID.
You know, there was like such a simplistic chart I saw the other day. Like basically, it was like it was called like how to trade. And it was just literally just a distribution. And it's just like you live here. Boom. All the art trading. Harris Kamal. Hey Marcos, been a while. Yeah, it has. It has. I was just saying that the other day. The first stream I had back on here. It goes February 17th, we said. But yeah, it's like it's July. It's been a long time. ain't shit changed, boy. First fucking stream back already juicing.
Black Swan is. And all of a sudden, stocks are panicking really quickly, really fast. So let's go with the following examples. We're going to go micro cap.
Harris Kamal.
Bullshit. And it goes down.
How's life with you? That's my question.
We're going to go MSTR. Love that example. And let's say that's down 90%. Then we're going to say Bank of America, BAC. Oops, that looks awful. We're going to say that's down 90%. Then we're going to say the S&P 500, down 90%. Then we're going to say Gov Bond, down 90%.
Futures traders, it's time to hear about Apex Trader Funding, the largest futures firm in the industry. They have completely changed the game with their new evaluation. So far,
Why isn't there a
they've
skip
already paid
button?
out over $600 million to traders around clear-funded accounts.
Microcap bullshit picker.
You have various trading platforms from Wealth Charts to Tradeovate to Rhythmic. The choice is yours. So make sure you use the code CF to get up to 90% off on evaluations right now using the link in the description below. Trader Apex today. Let's get back to the episode.
So using that framework, we can start to think about this now. The number of eyes on this microcap bullshit
Blessed,
picker,
I would say.
the number,
Yeah, I mean, good way to look at it. It's a good way to look at it. I think everyone is, one way or another. It's a blessing to be alive after all. Waking up is a nice luxury to have. That's amazing though. I'm happy for you. I'm trying to see everybody winning, right?
and amount of capital on the sidelines that wants to move into microcap bullshit if something crazy is going on in the world, guess what? Not that many people. The probability of this bouncing or then bouncing all the way is going to be very low, right? I'm not going to like that. So then if we take something like MSTR, which of course just largely despite being a software company holds Bitcoin. And so Bitcoin in a crisis and in a forced liquidation and a panic, I don't really know how that's going to perform. I think some Bitcoin maxis would say, oh, Bitcoin's going to go up. I would say I have no clue. I would say it's going to function like a risk asset like we've seen in the past. What should that risk asset be worth? I have no idea. So this is going to be better, but I'm not going to love buying that. Bank of America. So Bank of America is a very, very large company. It's a bank. It's stable. It's got pretty good deposits. It's well regulated for the most part, like especially post 2008. I'm not saying this can't go bankrupt or that something bad can't happen, but it's a hell of a lot safer than something with a bunch of debt buying Bitcoin. And so this starts to be kind of appealing.
Have I been following the World Cup or not? Not really. Not really. I mean, like I've seen games here and there. And I'll also see them at the gym sometimes. But like if you were asking what the bracket had looked like from the start, like I don't know. But yes, I have seen some games. I'm just not familiar what the current bracket setup is and who's expected to win, etc. But it's interesting though. It is interesting going out for the games. It was a good time. It's crazy. I don't know if you went out anywhere in the GTA, but like super busy, right? All the shit going on. There's just a Portugal game in Toronto a few hours ago. Yeah, I saw it was on while I was at the gym. I mean, it was like I didn't finish, but the startings of it was there. But yeah, I've been saying a bunch of random shit on social media too about stuff related to like Portugal and Ronaldo, and people are just doing weird shit.
But then, do I want Bank of America, which we've seen financial crises? Bank of America almost went bankrupt back in 2008. Even safer, though, is going to be a diversified basket of the 500 largest companies. And so once we get that diversification, this becomes even more appealing. But then something magic happens, especially in our most extreme example, government bonds. So if it's a US government bond, first of all, it has a very calculatable, quantifiable value. If that bond is supposed to mature and be worth par of $100 and it's down 90% and it's trading at $10, the beauty of this is you can calculate that, okay, as long as the government, the US does not default, which if the US defaults, microcap bullshit is probably screwed. MSTR, you can make some argument on Bitcoin, but for example's sake, that's not going to be good and its debt is going to be a mess. Bank of America is definitely defaulting if the US is defaulting, and most companies in the S&P 500 are probably wrecked. And so then the government bond is going to be extremely safe out of those. And because you have a quantifiable value, if it's trading at $10 and par is $100, first of all, oops, lost the cap. This is risk of the job here at Fanatics. And so the beauty of this is you can say, oh wow, I can make 10x my money
Mhm.
as long as the US doesn't default. So at a 99.99999% win rate, you can make 10x your money. And so this framework is then how we start to go through examples and how I start to think about this stuff. And this all sounds still very theoretical, but it is through this framework we can then jump to real world examples. And doing that, you go through the charts. And now we're going to dive into the parts that people really want, which is chart patterns.
Yep.
So any trader worth their salt should be saying, okay, Lance, all that theory is great, but how does this actually play out in the charts? I hear you. So let's dive into this. So going back to some of those variables, like speed and rate of change, I would say rate of change is one of the most important factors I'm looking for. So we can build the same framework and the same theory using chart patterns. And let's say we've got one pattern. How would you describe that, Riz?
Is it quite bearish?
Bearish, but would you say steady, crazy,
I'd
panic?
say steady by the looks of it, yeah.
Steady. And so I think generally when we
Oh,
describe
yeah.
something as bearish, I think if I had to guess, what your eye is picking up on is our slope. Oh, color change. Here we go. Our slope.
I'm so impatient. I was trying to put it on, like, if I wasn't
Negative
streaming, I would have just put this shit on like
1.5.
way faster speed and just
Obviously, I
fucking
don't have
blasted through
there's
this
no real
shit.
complication there,
Mhm.
but nevertheless. So we can then start to say if it's negative 0.5 slope, it's kind of a steadier move. It's not that much of a change.
Blasted.
There's not real panic. And rate of change, obviously, if something goes from $100 to $1 in a flash, that's really appealing, right? So now we can start to say,
I need something to snack on while this guy yaps.
Okay. this gets a
While this guy yaps away.
Fill my lungs with ganja when they fill my brain with drama. From my past, I have all this trauma. Getting cash off the racks on my problem. Don't work, no, it won't work out. But it don't work, no, it won't work out. It don't work, now the pain's worse. Yeah, it's gon' hurt. Hope it all works out. I'm stuck in my head too much. I'm stuck in my head. I'm stuck in my head too much. Trying to see where I fell from. Feels like I'm in hell. Shabuya to Belgium. Yeah, I've seen it all. Came a long way, walking limp from the crawl. I'm trapped in my head too much. I'm trapped in my head. I'm trapped in my head too much. They wonder why I get high as fuck. They wonder why I get high so much. It's because I'm trapped in my head too much. I'm trapped in my head. Fill my lungs with ganja when they fill my brain with drama. From my past, I have all this trauma. Getting cash off the racks on my problem. Don't work, no, it won't work out. But it don't work, no, it won't work out.
a little bit more aggressive, then we can start to say that gets even more aggressive. And then if we take this to an extreme, we can get really asymptotic, where something really waterfalls over.
Yeah.
And so that, if we then go in terms of slope, maybe we have a -1, maybe we then get a -3, and then maybe this goes and approaches like a -10. So some of the other variables we touched on were the boringness and how stable something is.
Mhm.
So now imagine this. Imagine you get something that is exceptionally, exceptionally boring. Oops, this was a double day there. Don't question the one Da Vinci B. So this is extremely boring. Something has been stable in this range for a really long time. Let's even take something like silver. Silver tends to be pretty boring, or even more boring, a currency.
Mhm.
And so this is also what I love about these thought experiments. We know that currencies tend to be more boring than silver and gold.
Yeah.
We know that silver and gold tend to be more boring than Bitcoin. We know that silver and gold and currencies tend to be more boring than stocks, and that Apple and Bank of America are going to be more boring than microcaps. So if we get the most boring thing, in theory, what we really would love is, let's say we break down, and then something that's normally boring makes an exceptionally large move. So we go from color change, we go from boring, and then out of nowhere, we go to extreme moves. This, I think the formal official term is we love, and doing that gives us smiley face.
Do you find as well, like this setup that we're looking at, is this more of a bigger picture idea versus if, say, let's say the average movement on the S&P is, I don't know, let's say 1% in a day, but then one day it does a 3 or 4% sort of move either side aggressively and sort of matches the other rules, but it's happened within that day and that time frame. Is it still the same concept to do maybe a day trade using the same framework, mental framework, or is this really done for like the bigger picture swing to maybe position sort of trades.
So the beauty of this is going to apply to every product and every time frame because it really works as a fractal. And these concepts are universal. And so when we get into the real examples, you're going to see how these patterns play out very much in the real world. And I think one of the most common mistakes people make with mean reversion is their selectivity. And so people will often say, but Lance, if I'm doing something like the right side of the V where I wait for that turn, it's death by a million paper cuts. And my answer to that is it's all about these concepts, which are fairly simple, but applied extremely selectively. And so if there is something like this with minus 0.5 slope, and then we kind of break, I'm not playing that. And so we're going to get to the tactical of how we trade this stuff, and that's going to be the key. Is there's nothing to say if something's boring. Like, yes, we might reverse, but that's kind of what happens. So how do you prevent yourself from buying here, losing, buying here, losing, buying here, losing, buying here, losing? So much like with our framework, we're trying to stack all of our odds in our favor. And what happens is if we get something that looks like this rather than like that, if we get something that's moving on no news, if we get something that's down 1, 2, 3, 4, 5 days in a row, if we get all these variables in our favor, what ends up happening is rather than being a coin flip and rather than being the theoretical random walk of 50-50, and rather than making $1 for a win and losing $1 for a loss, what ends up happening is our win rate goes up, loss rate goes down, this goes up, and that goes down. And so in stuff like this extreme example, whereas versus that one, our reward, if we do a 50% retracement, might just be that. Now, the beauty is when something panics, if we do a base case 50% retracement, all of a sudden, our reward, rather than that, might become that. And when we go through the examples, you're going to see that's exactly what I'm looking for. I'm trying to get the odds as high in my favor for a bounce. I'm trying to make the reward as big. And then through certain trading systems, we can very much limit our risk. When you do that, expected value goes through the roof, and we, again, end up happy trader.
And in terms of frequency, before we move on, what sort of frequency would you say this looks like on a monthly or yearly basis, depending on the time frame?
Sure. So it's always going to matter just how extreme, because all this stuff's on a spectrum. For all these variables, we're thinking about these different things. And so I would say in a very microstructure on the intraday, this stuff is panning out every single day. Now, the question really is, how selective do you want to be? Are you going to wait for pocket aces? And how do you define pocket aces for your product, your time frame, your strategies? Pocket aces, by definition, are going to be more rare. You might want the really, really huge multi-sigma move. You might want the 4, 5, 6 days down in a row, or 4, 5, 6 days up in a row in something extremely boring. So the more you go on the selective spectrum, where you need all those things in your favor and you're really jacking those variables up, that's going to be rare. But these concepts and these patterns are playing out every single day in just about every single product. So let's finally bring this all back to trading systems and how we can actually execute on this. So if you follow what I'm saying, essentially the chart pattern is going to show a lot of those variables. And the more of those variables we get in our favor, the better. And nevertheless, that's all great, but we need to be able to execute. So how does one execute? And that's where I bring in the concept that I call the right side of the V, which at its essence is saying, rather than buying on the way down, if we instead wait for the turn and buy on the way up over here rather than there, the beauty is that now we have a stop. That's our stop. And then we can catch this retracement. And most people, again, fall for that trap where if something has a slope of minus 0.5, what happens is, first of all, if this is something going from $500 to $499, the issue with this is our reward on a 50% retracement, if we just go back up there, not drawn to scale perfectly, haters on the internet, but our reward might just be 50 cents. Now, the difference is, flip some caps here. Imagine if this panics out and we went from 500 to 450, and then when we turn, we can actually end up bouncing, instead of 50 cents, we can bounce $50. And not only that, but the people that are willing to step in and buy at that discount, here, they're just getting a $1 discount. That's nothing. That's a 0.2% discount on a $500 stock. Here, they're getting a 10% discount when the stock goes from 500 to 450. You get so many more incremental buyers, you get so many less incremental sellers. And so your probability is going to go up, your reward's going to go up. And the beauty is you're going to then have your capped risk.
Do you find, what is like one of the biggest mistakes you see people making when trying to implement the right side of the V?
Far and away, they're not thinking about all the variables. They're taking way too simplistic of a viewpoint. And that's why we built that framework of
I can
all the
imagine.
variables to think about. Because what so often happens is if you're not considering what does the daily chart look like, what does the intraday chart look like, what's the slope, the rate of change, how far are we above...
That's the thing. That's the thing about trading, right? It's not like, it's not difficult, right? Trading is really not that difficult. Like, everything is just more or less like common sense, like pretty straightforward. but a lot of contextual information is required. That's the thing. So I can see why he's saying that. I'm sure people are watching this video and they just like whatever. I think this guy uses Bollinger Bands, for example. They'll just like toss on a Bollinger Band on any chart, and as soon as it starts going down, a green candle prints, or like hopping in, thinking that's like the strategy or something. There's like no context or no like anything being planned out about the actual scenario, what's going on.
Away from the moving average. How boring is this security? How many average trading ranges have we done? So even those variables I listed in the beginning, that's really just a subset of the infinite factors we can be thinking about. You can also be considering, what is the market doing overall? What are comparable stocks in its sector doing overall? What are different seasonal patterns? There's literally infinite things and variables you can systemize on. So now what ends up happening is with the trade decision, we're going to take all those variables and we're going to keep a mental rubric. The way I process my trades is at any given moment in time, I am constantly weighting all the factors dynamically. So every second, every minute, every day, as all these variables change, I'm trying to constantly handicap how good that expected value is. So in my head, I'm almost running this mental tally with all these variables. And so of course, some variables are going to be more important, but all of them are on a spectrum. So now think about it like this. Rate of change, daily chart, intraday, boringness. So if I could extend this to infinity, the reality is I would have all those factors. And what I'm doing is I'm just kind of like having this mental tally. Like let's say I rated each variable from 0 to 10. Let's say the rate of change was amazing. We really started to accelerate. So maybe I'm going to give this a 9. Maybe the daily chart, we're actually panicking to some support level, to some long-term support. If that daily chart's amazing, that could also be like a 9. Maybe the intraday was a little bit steadier, but it's still good. It's just not as good as that daily chart. So the intraday is going to be a 6. And so despite all those good factors, this is actually in kind of a volatile sector. Maybe it's semiconductors these days, and it's been kind of run up a lot. So boringness, it actually only gets a 2. It's not that boring. So in my head, what I'm doing is I'm kind of adding these up. And so this is a total of 26. And so something like this, maybe this gets, in scientific quant terms, 1 smiley. And so something like this, I might be willing to trade. And maybe I'm going to give this B risk. So maybe 26 equals B risk. And maybe if this got a score of only 20, that would be C risk. Maybe if this got a score of 15, that's just no trade. And so what most people do is they're not even considering all these variables. They're not weighing all the variables on a spectrum. And then they're just oversimplifying it and just saying, oh, if this turns, I'm buying. Rather than saying, oh, we didn't meet all the requirements. This is a no trade. Now, of course, let's say we were 10, 10, 10, 10. So 40 might be A plus risk. And so this is the framework of how I'm thinking about all these capitulation trades. And this is not one of those simple things. Like people want a simple answer. They want to know if X happens, do Y. And I think so many people get frustrated or think I'm hiding secrets when I tell them that, like, look, there's a lot of nuances and a lot of variables. And the beauty of trading is every play is similar, but every play is different. No play is exactly the same. And so if you're trying to just strictly memorize if X, do Y, it's never going to work because it's not that simple. It's all these variables. Like if you were trying to draft a basketball player and you said, if tall, draft him, like, okay, tall is a very important variable, but like, if tall but has no arms, that's probably not a good draft pick. If tall but has no coordination, that's probably not a good draft pick. If tall but 700 pounds and can't run, not a good draft pick. So you can't have this oversimplification. It really needs to be, wait, if I'm drafting and betting on this player, I need to weigh him on this full spectrum of variables that are important to me. You're never going to have everything. And look, maybe the play's not great for boringness, but that's made up for by this and this. So when we go through my examples, you're going to be seeing exactly how all this plays out, and I'll even go through some of those. So shall we finally, at long last, dive into these?
Yeah, let's do it. Should we quickly, before we do, look at the entry, like drawing element of the entry?
Cool. With that framework and understanding those generalized charts, how does one then actually define that specific entry? And that's going to come down to defining that change in trend. So even though this could be a masterclass in itself, this is going to be called defining the change in trend. So what might happen is...
And what was that guy's name? Fuck.
Break a trend line.
I remember his goddamn name now. Anyways, quite certain that like the way that he does the definition of the end of these moves kind of follows that guy's guideline, and he has like a book on it. Not a full book, but like a couple of chapters that go into depth about each of the features. I remember his name though. I'll have to look it up later. But it was kind of something he's like already alluding to, like number of candles, like one of them. If there's like multiple gaps like occurring back to back to back. Like the volume on the blow off. even on the lower time frame. All those kind of things.
So this break of trend line might be it. If something is panicking and really holding, we can have something that's holding prior bar highs. And that break is going to be what signifies that break of trend. Prior bar highs. Now, of course, this holds true for, even though this was a downtrend, of course, it holds true for an uptrend. Even though this is prior bar highs, it holds true for prior bar lows. And so you can even have a general trend that is, we're going to do and call this kind of, got to unsheath my weapon. So
Your lower lows, your lower highs.
exactly. So lower lows, lower highs, but then we break that, and all of a sudden, we get maybe higher highs and higher lows. And so break of lower lows and lower highs. Then in the most extreme scenario, which I'll squeeze in up here, there will be times where when you really go asymptotic and really panic and that slope really waterfalls, here's a thought experiment. If Apple were to go from 100 to 99, 98, 95, then it panicked all the way to $1 in one bar, and the break of prior bar highs was up at $98, I wouldn't wait for Apple to go from $1 to 98. So in the most extreme situations, I will be willing to buy an intrabar turn because the reward and the probabilities and the risk are just so in my favor. So in the absolute most extreme scenarios, I'm actually going to be buying kind of that intrabar turn as that then starts to reverse higher. And we'll see that come into play as well. So those are the entries. Then, of course, our stops.
Yeah. Well, you're about to do that,
Yeah, actually, and I'll even use good old red. So in something like this, it's going to be the lows of the move. In something like this with the prior bar highs, it's also going to be the lows. And in something like the break of lower lows and lower highs, when we then start to make higher highs and higher lows, it's going to be if that pattern ends up violated. So if this ends up coming all the way back and we don't hold the higher lows, then this is going to be where I get out.
Okay.
And this is also going to be low of move. So that gives us our entry, that gives us our stop. As far as then how long we hold, there can be the same pattern where if something is trended using prior bar highs, I'm going to expect that to potentially, in the best cases, trend and hold prior bar lows. If something was trending and holding lower lows, lower highs, once that breaks, I'm going to expect higher highs and higher lows. In something like a more extreme example, often that I'll still just give prior bar lows.
Okay. And the same on this side, just the prior bar.
Exactly. And I'll explain some of the pros and cons. And now the truth is, again, people want simple, but it's not always so simple. So there will be exceptions. And how do I define those exceptions? It's going to be weighing all those factors involved. So if some trade is absolutely amazing, like let's say it got like a 100 out of 100, if we finally break the trend and we haven't, like, let's say this was coming from like a mile away, we break that trend. And let's say as this develops, I don't necessarily want to stop out here if this is coming from like all the way up there. So there will be audibles and still just based on expected value. Yeah. Exactly.
In terms of this one here, would you be able to set an entry as like a limit or a stop order because of the nature of, let's say these are daily candles? You could just put that order in the market above that daily high to automatically enter.
Yep. So the beauty of this is, especially if you're trading a higher time frame, this can be very hands-off, where you already have your entry and you can have that in the system because the prior day's bar is already defined. And then as that pattern unfolds, you can very much just have your stop, and it's a very hands-off style of trading. And what's so funny is trading is complex, it's hard, but when you apply it to the right situations, it can be these simple systems that are effective. Like in the best trade of my career, I very much applied this simple system, combining some of these concepts, and then I just trailed it prior bar lows, and it just trended right back.
And now we're going to go through actual chart examples.
I don't know about that. Like waiting for it to okay, yes, you can obviously do that. You can wait for it to clear like the prior bar high on the daily, but like realistically, if that move is happening, it probably happened way sooner, way more obviously on the lower time frames, in which case you would have got a better entry for the same move anyways. So don't know if that would go with that, but each to their own, I suppose.
Now.
Let's do it.
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor in the CFD prop firm space, the one, the only, the best of its kind, Alpha Capital. Alpha Capital is unique when it comes to what they offer.
Why isn't the skip button? It always shows up. Why is this not showing up anymore?
Professional trading. So you have the opportunity to industry funded all the privilege to achieve trade radar. It's all there for checkout to get the best discount possible and all free its entirety, especially in terms of picture perfect, in the description below. Now let's get back to the episode. So now that we've gone through the concept in its entirety, especially in terms of picture perfect, what it should look like and the idea of it, now we're actually going to go through chart examples on the charts, what the reality actually looks like when identifying these type of trades.
Cool. And we're even going to go in reverse order. I'm going to show you that these concepts are timeless. And I've been collecting charts for my whole 15-year career. And the even funnier part is I learned from my trainer who's collecting charts since 2001. And if you go back to 2008 in the banking crisis and the financial crisis, these concepts still hold true. These trades still existed. I suspect they've existed forever throughout time. And for all I know, will continue existing forever through time until the AI overlords take us over and replace us as traders. So this OCLR example.
I don't know if that's true.
Back in 2000.
Like the way I look at these moves, like this is just like the result of like, how do we draw this? Like there's just so much money moving in one direction when these moves are happening that like the reversion will always come, but it takes time. So and like that additional time, because there's so much money that needs to like switch directions for it to really play out. That's how these moves get like parabolic, right? And people are like leveraging up on the lower time frames on these like big moves at the end because like they're juicing. Think about it. If like suppose like some assets in the middle of like a parabolic blow off top move, and you're just like scalping it intraday towards the end of the move, you're hitting some pretty crazy scalps up here when you're like leveraging up. Like the leverage is like ramping up at the end too, while there's like retail peak euphoria, etc. Boom, boom, boom. So I feel like that's just like always gonna happen, right? It's just kind of the nature of the flow of money. And even if you want to look at it in like a more like mathematical manner, let's just ignore absolutely everything. And you just create a distribution of all price action moves possible. There are always going to be these like weird outliers. Just by pure random chance.
16, before some of the young whippersnapper traders that we know were even alive. That's how old we're getting, Grizz. And
whippersnappers.
So we're going to 10/27, 2016. Okay. Like I said, we're going to 10/27, 2016. And so this was the stock Oclaro. And we started to trend weekly off the open. And so now back to that theoretical concept, this right here, I would describe as kind of slow and steady. It was like that first example that I asked you about. This is maybe a slope of minus 0.5. We then start to accelerate. This becomes a slope of maybe -1. And this is where we get that asymptote that I was discussing, that waterfall, where we go steady, 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 we start to accelerate, then we crash. And so if we go back on some of these variables, what we can say is this was pretty stable off the open. We were in a form of equilibrium.
Kind of stuff we were talking about, right? Like the typical things. And yeah, he's just like using the Bollinger Bands. But like in terms of like how that guy was referencing the blow off moves in that book, I know what you're seeing is the same symptoms. Like this big volume spike right at the tip too.
Crescendo, we then waterfall. We get a massive, massive spike in volume, which is one of the major ways I define capitulation. The stock has now fallen over 25%, if my rough mental math is correct, and about 20%. Fact check myself. And so this is like a really, really huge move. We can even then consider the daily chart. And on this daily chart, what do we have? Okay, it was like pretty stable. The stock wasn't particularly run up. And look how boring these average trading ranges are. On a normal day, we're getting maybe like a 30-cent move. So this really was an extremely large move on the daily chart. The volume was exceptionally large on the daily. And so this multiple time frame analysis is how I weigh all these different variables. Oclaro, I believe, we're going back a while now. This was just semiconductor stock and was pretty boring, pre-AI boom. And then the beauty of this is this was holding prior bar highs almost this whole way down. And so people will often ask, well, what if it's not trading super cleanly? What if it doesn't do prior bar highs and hold it the same way or make some clean, beautiful pattern? Well, guess what? You don't need to trade it.
Mm-hmm.
And that's about that selectivity, where so many people that are taking these paper cuts or are not finding effectiveness in these strategies, it's because they're playing the chart that they think looks like this, but it's really going up and down, up and down, up and down, and it's really grinding, and it's showing price, like this bar is price acceptance. I don't want this bar, I want this, where all of a sudden these bars are multiples of these boring bars. Like, look how big this is. We just showed you on the daily chart that normal average trading range was 30 cents. This stock is moving 30 cents per bar now, and off the open, we were barely moving 5 cents. So that's like, those are the nuances that make this so exciting. And like, you can see how much I love this stuff, and like, it just reminds me back of the old days of like learning and building these frameworks and doing these mental games of building these experiments and with these charts. And so now this was getting really big. Volume capitulates. So this to me, like, this is really an A chart. And you can buy this intra-bar, or you can wait for that break of prior bar highs and enter right around 725, and then give that an initial low down there, start to trail at prior bar lows, which effectively gets you out close to this moving average right around 757. And so people will ask, how do you get the win rate?
Interesting.
So obviously all these variables are on a spectrum. So I know that if I'm doing my little mental
rubric, that's what I was wondering when you're talking about the entries and you mentioned the targets, because that's like a pretty aggressive stop loss, right? At least like Interesting. Curious how big of a bounce this was and how the rest of the chart was looking on the higher time frames. Because that's pretty aggressive, right? If you're waiting for like a move like this, and you finally get it and you get filled and it starts to go, and you just like cut the full thing on the first break, I would definitely like take. If you're gonna be that aggressive, leave some running. Take like 80% profit or something. Leave a little bit. But very contextual though. Like, I'm not familiar with this chart or what's happening at the time, so like I'm not sure what kind of realistic move you could be expecting back up.
Oh man, this trade's a 95 out of 100, or like a 90 out of 100. Like, I give this, and now this is all theoretical, right? I have no mental rubric, but I would say this is like a 90 out of 100.
Like, if you think about it, like this trade, like he categorized this as an A as well. That's the thing, right? But clearly something he holds quite highly in value. And think about what this ended up being. He entered here, and his stop was here. So basically it was like a 1R trade, 1R and some change. An A setup. It seems a bit odd, but because like even this trade that we're in right now, right? Like, just think about this. Based on where we entered, it was already 7R. But yes, we have been shading on the way, so not exactly, but even then, still way higher than the one he's doing.
Good qualities. I know that when something has that many good qualities, the odds of this bouncing, this was probably like a 70-80% bounce. Now, if we were to go back here and this were to break the trend here, and you were to ask me about that, I would say that would just be like a total coin flip. If anything, it's less likely we bounce because we're just trending lower. So that might even be 40%. And so as this starts to really accelerate, as this waterfalls, and it goes a bigger distance, multiple average trading ranges, what's happening is your probability of a bounce is shifting from like a theoretical 40%, and then it's going maybe 50%, 60, 70. And then as that finally this huge volume capitulation and turns, that's going to be like a 70-80% win rate. And as you start to catalog these, you can backtest and collect these chart patterns in the past and then calculate win rates, or you can forward test and see when you do this type of trade, how often does it end up tending to be a winner? And that's how you build these statistics. And then you can, over time, calculate your math. You can say, what was this distance? Okay, it was maybe about 30 cents or so. Then you can say, what did you end up making? About 30 cents. But the key here is, even if the risk reward is equal, the beauty is that the win rate is so high, and that makes this a really solid trade. But notice how this was perfect based on some of those chart examples, and I'm using that framework of all those variables and nuances to judge just how good this is. And it's not as simple as just the intraday chart. It's all those variables together.
Would you say one mistake that people make is that they will try and hold? So, you know, classic, once we've gotten down here as part of this move, is we're kind of playing on the fact that there's a lot of emotions in the market and we're expecting to have some sort of bounce correction and mean reversion, right? Do you think there's a lot of people who may execute this well, but then they'll try and hold for to back to the highs or back to the, where, basically complete the move back up, and therefore where they should follow the rules in the system, they end up making that mistake of allowing those emotions of how low we've come, and then that greed of, okay, this is how much I can make if we get to here, or you're back to the highs. Do you find that that's a mistake that a lot of people make?
Yep. So of course, a lot of times you do need to factor in reality, which is this stock just panicked all the way below $7. will people be rushing to buy this at 840 or 830s?
You know, the thing
When you
about
can
this
buy
is
it
like
one-
this whole discussion. Like, hey, if you take profits at like set points on the way up, then like, you don't have to worry about bitching out of the trade, and so like you leave yourself open to the possibility of getting the move, right? Like, no one knows if it's gonna reverse like right when it comes back to the VWAP or like the Bollinger Band moving average, or like keep going or whatever, like what this level is, right? But like the way, if you're just gonna full exit when it gets there, like you're just cutting off the entire possible like world of scenarios where it keeps going higher. I wouldn't do it like that personally. Seems a bit inefficient.
20% off, a little bit less than 20%. I know people will get me for that one. But when you could have had it at this discount, are you going to race to immediately buy it back at 830? No, of course not. And yes, it theoretically can happen, but the odds are stacked against you. So that's why I love using this moving average as a form of equilibrium. This is just part of the Bollinger Bands. It's a 20-period MA. And so I view this as just equilibrium. And so oftentimes we do bounce there. So I can use that as a rough price target in my mental math estimation. So if I'm wondering how far can this bounce, and I'm trying to weigh the mental math and approximate it, I can just say, okay, at this bar, the prior bar high was 725, and this moving average at the time was at 788. This, of course, will come down with these lower bars.
Also, like I guess another thing to consider is like he might be saying this from like a purely intraday scalping perspective. In which case, like the concept of leaving a runner is like not that as relevant. Hard to say. Either way, though, I don't think like the
but I can know,
doing
okay,
it like that is
if this bounces sharply, I
ideal.
might make 50, 60 cents. If this starts to bounce less sharp, maybe I only make 30 cents. And overall, this was what I would describe as a pretty typical expected outcome. Like this would almost be my base case expectation for this pattern. Like very, very typical, where we held prior bar highs on the way down, big volume capitulation, we turn, we hold prior bar lows on the way up, and bounce all the way to that moving average. So for me, as far as just kind of textbook, I would call this like a nice like A trade. It's a single, like this is very textbook for what I'm trying to explain here.
I love that.
Beautiful. So now we will go to another one in the history books, which is this NGD on 131 of 2017. So NGD is a gold stock still in existence today. And what we see is the stock had news the prior day, had a weak sell-off, closed really, really weak. But then it was that next day that we did even bigger volume and had this capitulation mean reversion-esque pattern off the open. And so again, what we got is, and actually let me even jump back here for context for another second. This stock is again normally very boring. In terms of boring sectors, gold stocks are quite boring. They trade off the metal, right? It's a pretty quantitative thing that they can say if gold prices are this is where the stock should roughly be at. Most gold stocks, if gold stays the same and you're a developed gold company, it's not going to go up 500% in a year and it's not going to fall 90%. It tends to be stable overall. And these average trading ranges, we're talking about an average trading range of maybe 5 to 10 cents, maybe 15 cents.
The thing I'm curious about
And
is how he
what ends up happening
scans for
is, yes,
these. You can't necessarily like, yeah, you can have like the Okay, suppose on the daily chart you're not getting some like parabolic move, so you're not watching this thing for this like 2-minute breakdown waterfall he's talking about. Like on a chart like this, like okay, it gapped down, had a big candle, and then the second day is when he took this trade. Whereas this move could like have prolonged downside in the higher time frame. But I'd imagine he's like scanning for something on the lower time frame to like identify these.
we get news and it's a big move down. So you do need to adjust for that recent volatility. And so then this starts to sell off. We hold prior bar highs. We then get that same volume capitulation. The stock has moved, I don't know, 25+% now, which is pretty awesome. And it's that same pattern where we can buy.
Like even something like what? Number of red candles in a row greater than a certain number, plus like a volume that's higher than average, probably would catch a lot of these, I'd imagine. The candle one's a lot more subjective though. There's lots of different ways you could configure that. And same with the volume, you could have different thresholds. And different ways of calculating like what kind of volume you're looking for. I'm curious if we discusses any of this stuff or no. Or no.
Buy that break of prior bar highs. This holds prior bar lows, and now we catch this move up to here. So I'm going to go back to those prior variables we used. This stock was very volatile the prior day on news. This stock was less stable off the open and was making kind of a bigger move from the start, unlike the OCLR where we had that equilibrium. And we have this nice panic, but it doesn't really crescendo and waterfall as much. So what ends up happening is this ends up having a weaker bounce, which is totally fine. And so overall, if I had to do my little rubric, I would say this is an acceptable play. But the other issue is our risk to lows when we buy here at 252 or so, our risk is 13 cents. And because of this big wick on this candle, that's actually a pretty far stop. So if we were to calculate the expected value on this, it would end up being just okay. And so that's how I'm using this rubric, right? It's okay, I love that this is a boring stock. Love that it's a boring stock. I love this volume capitulation when normally stocks do the most volume off the open. Yet now, almost 20 minutes later, we're doing this move. We easily could have opened at 250 rather than opening at $3. We traded, trended down, and then capitulated. So there's also the news of prior day, so the average trading range is bigger. All these different factors, including this wick, as I described it, increasing our risk. So those nuances are what makes this play far more marginal than the OCLR example. And I would give this, okay, maybe it's worth it. This would kind of be a fine, super small, maybe like a C trade. You do a little bit of risk and it's okay. And what you'll find also is,
I mean, the waterfall on the other one compared to this is like not even comparable, right? That other thing was like almost certainly some large perp play entity was unwinding a position, right? Just constant selling of like the entire open, just the algorithmic just dumping of a position.
variables in your favor, you end up having a better bounce. You might bounce to the moving average or even beyond it. On the trades that are much weaker in quality, you're more likely to have a weaker bounce or no bounce. And then, of course, if the slope was super steady, I would expect even worse of a bounce. So do you see how that framework of understanding price action and why that logical framework can be applied to give us kind of that spectrum of outcomes?
Yeah, so it then allows you to have a more realistic outcome. Going back to what I was saying on the last one, is that, you know, is the issue of people trying to hold too much? It kind of, that will come down to one, the emotional side, but equally, would you say that more people get emotional because they lack that sort of understanding of the variables, that they haven't done that mental framework of, okay, what are the variables dictating is possible on this particular trade? So then it's easy to then allow your emotions to hijack you in the moment because you haven't really understood what the market's really representing to you. So then kind of goes back to that point where a lot of people blame emotions when really it's that lack of insight and work, right?
Yep, I love how you said that. And it's true, because the more you have done the work, you understand the framework, you understand price action, you have the reps, you have the charts, you have all these patterns memorized. When you have done that work, you have this deeper understanding that allows you to be more confident and less emotional. And you have that experience to trust in the pattern. You know that, oh wait, I'm holding, in this case, maybe I'm holding 10-8 or 10-9. You know your hand and you know how to play it, so therefore you can act way more accordingly and it's less of a guessing game. The other thing I would say is, the truth is, for the average trader, most people, you're actually getting a little bit too much credit, I will say. Because the truth is, what most people are doing is they're buying here and they're stopping out. They're buying here and they're stopping out. Then when it stays steady and there's less inventory,
Who's
still
doing
buying in,
that?
then they're like, okay, maybe rather than stopping out, I'm just gonna hold on to some. Then it really accelerates and they hit out. Then they've just lost once. They've lost twice.
Who the fuck is entering along here and getting stopped out on the next candle? I can understand like getting filled on like a bigger position as it's coming down, but like, what is that? Ain't no way people are doing that. Oh my gosh. That is funny.
They've lost 3 times. Then when the turn finally comes, they're licking their wounds. And I don't mean that to mock less experienced traders, because trust me, I have done this mistake a million times. I still do this mistake sometimes. And even when I sometimes fight on the front side before the turn and I'm buying and I take some losses, even when I do that, like, I still fight and struggle with those emotions, and I need to say, oh wait, Lance, like, you're not waiting for the turn. And so people do this, and even I do this, and I got to say, whoa, and that awareness only comes from experience. But that's what most people do, is they're taking the losses on the front side, and then they're losing when it capitulates, and then they give up for the bounce. And it's not just beginners. It happens to me sometimes. It happens. I work and mentor other 7- and 8-figure traders, and so there's a trader this year who I have the utmost highest admiration and respect for, and he got.
There's no way he's talking about people that he actually works with that yeah, stop out like that, right? Like, how do people struggle with that? It's such like a straight up, repeatable, mechanical way of entering.
Quantum short, and then wasn't in it for the turn. So it happens to everyone. But that's actually how our base level psychology can get us, when we don't have the experience and that awareness to say, whoa, take a step back. I need to wait for this turn. This is my system, and we all make those mistakes.
Of course. Yeah, and the worst case is that people.
Yeah, maybe when you're first starting though, not what he's describing, like 8-figure traders. I don't know if anyone will be doing that.
flip to selling because they think that's the and then
Yeah.
that's
Oh
when the
wait.
buy takes
Yeah.
place.
That's when you say, oh wait, maybe this is going to zero. You're right. Yeah. I've done that too. If I wish people could see how bad I was in the beginning, and if people think Lance had any raw talent for trading, they'd be greatly mistaken. I had no raw talent. I was a steaming pile of dog shit where I did the exact opposite of what you should be doing.
Yeah.
And only from doing that a million times and slapping myself and beating myself up and saying, Lance, come on, like, what's wrong with you? Why can't you do this? It took so many reps, so much training, so much mental awareness of don't buy the front side, don't buy the front side, don't buy the front side. Lance, no matter what you do, don't buy the front side. Wait for the turn, wait for the turn. Okay, I think this is it, and you don't buy. Then you're like, I think this is it, I think this is it.
Yes.
Then you buy up here because you're like, oh wait, it's definitely bouncing and turning. Then you chase the top, then you stop out there. And so I've made every psychological error and mistake in the game. I've let every base emotion ruin me and do the bad trade. And it literally took me years to reprogram myself to not do that. And it's a constant refinement.
Yeah.
Like it's like I always laugh how David Goggins is like, no, you don't understand. Like, I am a piece of shit. I am a lazy piece of shit. And every day I need to convince myself to not be a lazy piece of shit.
I don't know, man. Like, this is one thing that has bothered me so much about getting into trading, and hearing like this being such common sentiment from people. Like, you have a perfectly defined way of entering the trade that you already know beforehand. What is the issue with following that when it's happening? It's like the most straightforward. You don't have to think about anything because you know exactly what you're looking for. You don't have to sit there overthinking. It's like either this thing happens or it does not, and you're just fucking chilling.
And I think people think that like good traders or robots are unemotional. It's like, no, you don't understand. Like, literally every day in my trading, I need to say, Lance, don't be a dumbass. Like, fight those emotions, fight those emotions, fight those emotions. And I still sometimes am a dumbass and do the wrong thing.
Yeah.
But the awareness increases over time and your experience level to be able to say, whoa, okay, like most of the time I'm good. This time I messed up, but I'm aware and now I'm fixing it.
Yeah.
And so it's
Like, I don't even know. Like, I find the after the trade entry like the most emotional part, in the sense of like, it is so fucking annoying when like it comes down and misses your like limit order by like $1, or your TP doesn't get hit by like a hair, and then it just ends up like coming back down. See, that stuff is annoying because you can never know, right? In terms of like executing the plan to get in and whatnot, I don't really see what there's too emotional. What are you getting emotional over? Poorly planning. That's the root cause, I always suspect.
this game is never easy. Never.
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor, TradeZella. TradeZella is the #1 trends pro, and no matter what you're actually getting this, make sure you go to it.
Okay, another example I love. One of
The thing is, I wish more people talked about that, because I feel like it's like some people are like, use emotion as like a crutch of why they're not trading well.
moves kind of that COVID timeframe.
Okay.
Which is going to be a fun one. Okay, this was July 29th, 2020. And so this was one of the craziest trades during COVID. Oh god, I can't even remember the actual headline. It was somehow Kodak got involved with like Operation Warp Speed back in COVID. Mega short squeeze where this stock was like super boring. Let me see if I can even.
That's a crazy move.
Look at this. So this stock on average was moving 10 cents. Very boring. I think we all know Kodak is the camera company. That is unquestionably a shitty company for quite some time. It has done nothing. Then it ends up somehow involved in Operation Warp Speed, explodes going higher. And so then a lot of people that were short ends up being a massive liquidation. So when we think about this, Kodak, very boring company, very old, stable company, and one that's ultimately struggling. People get kind of caught. We do a massive gap up. So we know this company's stable and it's a huge move on the daily. And this volume is unlike anything just ever seen. Like, for comparison, you cannot even see volume bars here. I think that's a pretty good sign of how extreme this is you visibly cannot see the volume of what it was prior doing. So that's our daily analysis. We're now going to jump to 729, and this is 729.2020. And so I use a 2-minute chart, but of course this applies on any time frame. And so what we see here is the stock starts to move off the open. Nothing, yes, it had that prior day move, but nothing like so face-ripping and unbelievable. And the stock starts to go. We start to pull back. We then curl up. And this was already a big
Like, did they halt this or something? Like, is this like a halt and it opened down here?
A lot of people are probably piling in short, thinking it's done for. And then what happens is we break out, huge volume comes in, and then massive.
It wouldn't be after this candle, would it?
The stock on the actual news didn't even move up that crazy. And now we're just purely skipping prices. To go from 20 to 60 on a stock that was just a couple bucks beforehand, this is crazy. Not only that, we are super far above the upper Bollinger. We're really far away from the moving average. At the time of this peak, the moving average was at $26 and the stock is at 60. So it's over 50% lower is the moving average. And so really crazy move. And again, we're holding these prior bar lows. So super sharp trend, the kind of reverse waterfall. And then we get that break of prior bar lows and we get that turn, especially this intrabar turn of that.
Like you can use like the that's the thing, like you don't really need to use actual Bollinger Bands per se, but like you can like monitor the you can monitor like the historical width percentages and then like plot out the extremes.
Where we're green. And again, the same way in our framework, I was talking about number of days up or down in a row. It's a fractal. It applies on any time frame. So 1 bar, 2, 3, 4, 5, 6, 7th bar up, and it reverses, then boom. And so that simple system here, now, of course, this is one of the most extreme examples. Like this was one of the best trades of 2020, but it follows that framework of this was a very boring stock, making an exceptionally large move. And this intraday chart was probably 10 out of 10. So this had so many variables where if I did my little rubric and added it all up, this was probably like a 95 out of 100. The main risk for this was a short. And so God forbid you pile in short and then somehow we really lock limit up and we get halted. There's a lot of uncapped risk there in something like this. Now imagine if this stock was a stable $100 stock, then it the next day panicked to $80 on bad news. Then we opened up at 60 and panicked all the way to 20. Like imagine if we reversed these prices and made this the downside and something went from 100 to 80 to 60, then panicked to 20 like this in this type of chart pattern. That as a long would be like trade of the century because you can make so many multiples on that in what was a very boring stable company at 100. So just a few days prior, in theory, it was this like that's how these concepts apply. And so this would be like a 95 out of 100. The con, of course, is hey, just in case this were to not work, the short side is more dangerous. And as a result, I might want way less than if this was a long, but nevertheless, I still want a lot because the reward on this was amazing. You ended up making.
I'm just thinking about how like that kind of having to worry, like what a stupid problem to have in trading, right? Having to worry about like halts and getting gapped on and whatnot. Like that's a nice thing about perps. And I'm very curious to see how like Hyperliquid develops in terms of offering more and more of these things as perps
over about $20, which is phenomenal.
Definitely, yeah. And the risk is still capped to lower in terms of about $8.
Yep.
So then you're getting that closer to the over 1 to 2 in terms of its risk to reward on
Exactly.
this.
Yep. So you're talking about probably about a 3 to 1 risk reward. I'd say the probability once this turns after a move like this, so many up bars in a row, is again probably at least 70%. The only con is that tail risk. Just God forbid you get stuck. But that's
what's the reality of speed? So in this case, as you said, these are 2-minute candles and bars. In terms of being able to execute effectively, get the right pricing, the right risk on, etc. How does that work? Do you have to have sort of hotkeys? Is there certain elements that are going to be really efficient or almost necessary to execute properly for these sort of trades?
Yep. So for something intraday like this, and this particular example, this was very quick. But then of course you could have caught this print and more liquidity in here. So this was within seconds once this turned. And then you're definitely wanting to use hotkeys. You're definitely needing to be super quick on the keys if you're trying to point and click in something like this. Not the arena you want to be in for sure.
Of course.
And that being said, there are examples which I can even now jump to where you're operating on a daily time frame because these concepts, like I said, are fractals. And you can do the same thing and apply it on the daily chart for the people that aren't day trading, that aren't super quick on the keys, or trying to find strategies that are more conducive for part-time jobs and part-time trading.
Yeah.
So let's jump to one of those. We're going to go to a recent example as well. And so this happened in October 2025.
Oh, nice.
And so this is the ticker UAMY. And this is one of those just critical metal rare earth stocks. And so normally this stock has been quite boring. And we're even going to get context long term. So this stock, I think the technical lingo is this was a piece of shit for a really long time. I mean, we're trading at 20, 30 cents. It's a piece of shit. And we start to break out. We're going up. And even this year, though, amidst all the trade tariffs and the US-China trade war, we're still only about $3. And so what ended up happening is some of the rhetoric around the rare earth metals starts to accelerate. And this breaks out very, very aggressively. And going back to our framework, this is a stock that had been exceptionally boring and exceptionally a piece of shit. And you need to be a little bit careful just because these market caps, again, on that spectrum in that framework, market cap, the lower the market cap, the more risky this is. You're not going to see something like NVIDIA or Tesla make a move like this, though. So that's kind of the pros. You get these crazy moves. And so this breaks out. And now look at these initial bars. Even on these breakout bars, we're maybe moving about $1. But look what happens. We hold prior bar lows, 1, 2, 3, 4, 5, 6, 7, 8, maybe it's like 9 bars if I had to eyeball it.
Yeah.
And then the range of these bars accelerates. So even versus a couple months ago, a range on some of these bars, we're talking the low to high is maybe 35 cents. Even when we start to get volatile, we're talking about a range of low to high of like $1. Oops, a little bit too much. And so what we see here is, okay, dollar range. Then we start to have like a $3 range. Then all of a sudden we start to have a $4 range. And then we have close to a $5 range. So this stock is really capitulating to the upside. It's doing so on massive volume again. It's holding prior bar lows. We're far above that upper Bollinger. We're really far from the moving average. Yes, there's news in the sense that there's a trade war going on and some of the escalation between China and the US over the metals, but there's nothing fresh per se. That's kind of what's been driving this whole move to begin with. Nothing so fresh on to explain this acceleration.
Yeah.
And when we go through those variables, we start to say, wow, this is really, really good. Between the volume, the magnitude of the move where the stock has over doubled in a matter of a week or two, we've done so extremely cleanly. The price is going kind of asymptotic. And all of that is really favorable to do this. And so you could have traded this on a intraday basis, but then you can also trade this on a swing basis, where when we break prior bar lows, is right here at about 1550 or so, you can short that and give an initial stop up to there, and then trail using prior bar highs. And the distance to the moving average is pretty good. And we ended up not making some amazing reward, but we do end up making about, I don't know, $3 or so. And the other thing is, past this first initial day, your stop and your risk.
See, like this is an example of what I was saying of the first one you talked about, right? Like, so again, he got out based on his rules, and then look at what he missed. He missed this entire move. He could have just left at least a bit.
And starts to trail. So once this day kind of elapses, your risk only ends up being $1.
And the other nice thing about that too is that like when you do it where you leave a bit of a runner, you can add back to it. So you can compound back into that position. Like suppose that like he got out whatever and then broke his rule and he like shaved here, whatever. Let's just say he wants to take most of it, so we'll give him like a high amount, like 90 to 70% of the position window shaved. You leave the rest, and then you can like play this breakdown, or even like on the lower time frame, try and get in on one of these like retraces. Because you have so much wiggle room with like the original stop too, so it's like I don't know if I agree with that one, man.
So other ways you can structure.
Don't know if I agree with our boy.
I don't know if there's ever any absolute optimal way to do this, but what I would say is you can backtest or use this framework for, okay, if this wick is really far away on the prior day and I short here, maybe I just want to give it to the highs of this bar. And a lot of times that can be acceptable. And what you want to do is see how does that affect your win rate? How does that affect your risk and reward? And all of this ends up being acceptable. And it kind of just ends up being like your own personal belief in your data and everything else. And that's kind of some of the art and nuance of looking at how good is this intraday? How good is the intraday setup that I think is going to trade cleanly? How confident am I we won't break here versus up there? And this is another just kind of textbook awesome swing trade example that traders could have done this here. And it's very much applying those same concepts in that framework, where I would give this, again, being to the short side, it's a little bit riskier. The market cap's a little bit scarier. This wasn't particularly super liquid. So I would give this probably maybe a B+, A-, just because this move was so far from the moving average and the scale of it and how boring it is.
Yeah.
So it's all those variables coming together.
Which, as you said, so like, factoring in the market cap and the short nature will still distinguish. Because I think a lot of people always, as we've talked about a few times, they would see an opportunity and then just execute accordingly, not taking in these different variables that really do change in terms of the actual trade setup that's presenting.
Yes, and if we go to some comparables, like this USAR was another rare earth name. And if we look at this chart, this was a fine short, but this to me, it wasn't moving as cleanly. We had some down days in here. We had these red bars. It wasn't as clean of a trend. So this actually ended up working and would have been fine. But for the most part, I'm trying to use my framework and go for the most extreme examples. So I'm shorting the UAMY just because the magnitude.
I'm actually curious. I mean, I don't follow like these things he's talking about enough, the actual tickers, to know what's going on. But I'm curious, like, which one of these has like more relevance, whatever like basket they're a part of. It's quite interesting how different the candles are for both of them. This one's like this like crazy, like just massive pullback right back to the open, basically, right?
Earth name. And if we look at this
Interesting.
chart, this was a fine short, but this to me, it wasn't moving as cleanly. We had some down days in here. We had these red bars. It wasn't as clean of a trend. So this actually ended up working and would have been fine. But for the most part, I'm trying to use my framework and go for the most extreme examples. So I'm shorting the UAMY just because the magnitude, the cleanliness, the amount of up bars, all those nuances help increase my win rate. And so even though this USAR ended up working, in the aggregate, those decisions add up. And it's the difference between me avoiding a lot of the losses other people take, and then me also sizing up the best ones much more aggressively and doing that concept that I often talk about, that exponential bet sizing.
Because to your point, like it worked out this time, but then all the times it doesn't work out. That's always the trick, right? The time it works out, you usually don't take it, and then you try every other time and it doesn't work. Or the worst case is the one time you do try, it does work out, and now you're convinced every time that it doesn't, that it's okay because that time it worked, and that becomes a spiral in itself.
Yep. And the thing is, you're always going to have losses, right? And so you need these wins to really offset all those other trades. I think most traders, we all make mistakes, we all lapse in selectivity. So you really got to make the really, really good charts count. And so to give you 2 more examples, I wanted to be really recent on one, just to make it fun. So we're recording this in late November, just before good old American Thanksgiving. And so this Bitcoin chart, what ended up happening is we had a lot of price acceptance, and we were maybe a little weak. We try to break out. We get these highs. We kind of collapse. We get a lower high. We get a lower low. We get a lower high. So this is one way to define the trend. We're also now below this moving average. And so this was a sharper move of price acceptance, a little nothing move. But now this is almost like the 3rd leg down. And so the more legs, that's another one of those variables where I love stuff that has made like 3 legs or more down, because the more legs, the more probable of a bounce. And the more legs we've gone, the more I can argue, wait, equilibrium price is like up here, not just down here, but up there. And so in this example, we had this initial leg, weak bounce, even smaller next leg, but then we start to really panic, and then we flush out. And so this flush out was the first time we're kind of meaningfully below the Bollinger Band. We're really far from the moving average. Like here, we're just kind of in the range. We're not far from that moving average. We're not below the lower band, Bollinger Band. Here, it's okay, we're just barely. Now, this is multiple legs. This is the highest volume flush out we've had. And now we get Bitcoin. This fell kind of like, I mean, from that prior close, like that was almost a 10% move. And if you were to go to this intraday, which we will, you will see this was very, very panicky. And so this is what then sets up a potential long and even a swing long. So now we're going to jump to that price action. The other thing I'd say is Bitcoin on the spectrum is hard to value in that it's not quantitative. There's no cash flows. That being said, the Bitcoin is pretty accepted at this point. Like it is very institutionalized. There's ETFs. Everybody's watching it. There's a lot of capital kind of arbing it out. And for the most part, it's pretty steady. Like look at some of these bars. We're talking about a 1,000, 2,000 bar range. And then, like I said, we had an almost $8,000 range. So now we're going to jump to that intraday. So now look at this. Right around 2:30 a.m., we got this massive, massive liquidation. And so, I mean, I was asleep during this. I did have bids in, which was amazing. And so this is so big where this, to that chart example that we did earlier, is one of those times where you might want to buy intra-bar because the waiting for that.
What?
That turn here is one of those times. And so massive, we're going to jump to that intraday. So now look at, and that part, it's pretty steady. Like look at some of these bars. We're talking about a 1,000, 2,000 bar range. And then, like,
okay. That bid statement, a bit odd, no? Based on the strategy that he's describing, a bit odd. Like surely he had other reasoning to put the limits.
$8,000 range. So now we're going to jump to that intraday. So now look at this. Right around 2:30 a.m., we got this massive, massive liquidation. And so, I mean, I was asleep during this. I did have bids in, which was amazing. And so this is so big where this, to that chart example that we did earlier, is one of those times where you might want to buy intra-bar because the waiting for that turn here, at that point, if you're waiting to buy up at 84,000, most of this move is already retraced. Like Bitcoin just fell 5% pretty much in 4 minutes. Massive, massive move. So that's where it's a stop is harder. Like you might need to wait for an intra-bar turn. Or, and I know this is kind of heretical to even say, you might be buying some front side for small size without a stop. Like I absolutely will buy stock, crypto, whatever you want to call it. I will buy stuff on the front side, but my size is so much smaller. And in the case where, I mean, I was literally asleep, I had bids in. So when I'm doing something blind, I'm even smaller, right? And so this made this panic. And that's one of those situations where you can buy front side and then look at this bounce. So this massive, massive bounce, almost a full 100% retracement. Why was this retracement so big? Because this move was so extreme. This was the most asymptotic, most waterfally, most panic we've seen of any of the examples. Look how stable this was. This was not even moving, I don't know, $100 a bar maybe, $100 a bar, if that. Then out of nowhere, we dropped.
Is it me or does this make no sense? Like, I can't know. Like, what is the point of him explaining all this when it's not relevant? Okay, he's looking at the 2-minute chart right now. And he's saying that he was asleep. So like him sitting here talking about, oh look, it was tightening up or starting to roll over or the prior bar high, blah, that's irrelevant. It's irrelevant. You're fucking sleeping. So So like, why are you talking about it as if this was like you executing your strategy? Like this set strategy. Kind of seems a bit nonsensical to me.
5% move in 4 minutes.
Yeah.
So that is one of the
Also
things-
curious, like how did he set his TPs for that? Seems very odd, right? This seems like a very odd statement to make. Is it just me? That's a little bit of a alarm bells are ringing hearing that. Odd.
table, this is like the probability of this bouncing is so high, but you got to be careful if you're buying front side, and that's why sizing is key. But then it's not surprising to me that this bounces like 80%, that this holds prior bar lows and does so well. So that is amazing. But then we end up rolling over. And so what we end up getting is we bounce. But then if this is kind of the high, the higher low, the higher high, we break that higher low, and we then start to have a lower high, and then we have a lower low, lower high, and then we panic. And so then I'm sure a lot of people flushed out, but we reclaim. And so then even here, we kind of break that trend where this was the low and that was the lower high, but then we break it. And not only that, we also break that moving average, which was a little bit of resistance. And so then you can re-enter and structure this trade. And now say you're a swing trader. If you're a swing trader and you bought some intra-bar, you can then trail this using prior bar lows. And so part of the appeal of this becoming a swing trade, and I'm at the time of this recording still long some of this Bitcoin for that reason, is this was leg one. To me, that was leg two. This was a way more capitulatory leg three. This was the highest volume of the past few weeks. Like I said, it was the most extended. The intraday was a really big panic. We break trend. So then if I want to do this as a swing trade, so I had
When was this?
using a lower low, lower high, and then we panic. And so then I'm sure a lot of people flushed out, but we reclaim. And so then even here, we kind of break
We were in
that
this
trend
trade
where this was the
too,
low
I'm
and that
pretty
was the
sure,
lower
right?
high, but then we break it. And not only that, we also break that moving average, which was a little bit of resistance. And so then you can re-enter and structure this trade. And now say you're a swing trader. If you're a swing trader and you bought some intra-bar, you can then trail this using prior bar lows. And so part of the appeal of this becoming a swing trade, and I'm at the time of this recording still long some of this Bitcoin for that reason, is this was leg one. To me, that was leg two. This was a way more capitulatory leg three. This was the highest volume of the past few weeks. Like I said, it was the most extended. The intraday was a really big panic. We break trend. So then if I want to do this as a swing trade, so I had bought some, I scalped some out as this bounced. Now I'm still swinging a core. And so I'm just doing this. Initially, it was going to be to lows. Now it's just prior bar lows. And so
Pretty sure we were streaming at the time. Are we? Dun, 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 dun. 21st. Yeah, we were. Because if I recall, we were a bit late to get in on this, right? Like missed our order or something. We ended up like chasing the move a little bit. We were definitely streaming it.
So I don't know when I'll get stopped out, but for me, if this does bounce well, the moving average is all the way up there. So it's feasible that, I mean, now like today isn't so great. Yesterday was a really great close, but it's feasible that this could, bounce into the low 90,000s, or even if this was a really strong bounce, which is not happening today, there's a world where I could have seen this bounce to like 95,000. And so that's like a real world example of how I'm structuring these trades and combining all these concepts where Bitcoin has been extremely stable. We did lose almost 30%, actually more than 30% of its value over a couple weeks. Okay, like nothing's really fundamentally changed. Like the market had its own little pullback, and like the market panic is kind of what led that to flush out in the way it did. So it's understanding that, okay, Bitcoin's like, look, you can't quantify it, but it's pretty boring. The daily chart's awesome. The intraday was a panic, and using that framework and then defining a trend, they kind of capture this stuff.
Definitely. And just final question then before we wrap up, in terms of scanning for these opportunities, how does that look from your perspective? Are you looking at things that are going more parabolic to then identify, are we looking to turn? Like, how does that look from the sort of identification side of things?
Yep. So all of the above. So I have daily chart filters that are scanning for stocks above the Bollinger Band or below the Bollinger Band. I have filters that are scanning for number of up days in a row and down days in a row. So you can build filters where it says, I want to see patterns that are holding that prior bar lows pattern or the prior bar highs. So I'm 1,000,000% scanning that. I'm always looking at the most in-play stocks, and I'm always trying to move to where the best setups are. Never do I wake up saying, oh, I'm going to trade A, B, and C today. I wake up with the mindset of I'm going to trade whatever's offering the best opportunity.
Love that. Lance, I'm sure there's plenty more that we can go into, and hopefully we can have you back on Chart Fanatics, but thank you for going.
It's where Bitcoin has
Gotta
been
hear that
extremely
again.
stable. We did lose almost 30%.
You're looking at things that are going more.
Yep. So all of the above. So I have daily chart filters that are scanning
Oh
for
shit.
stocks above
Oh
the
my
Bollinger Band
god, I almost
or
spilled
below the
water on my
Bollinger Band.
keyboard.
I have filters that are scanning
Can't
for
believe I
number
just
of
caught
up days in a row
that.
and down days in a row. So you can build filters where it says, I want to see patterns that are holding that prior bar lows pattern or the prior bar highs. So you can build filters where it says or below the Bollinger Band. I have daily chart filters that are scanning for stocks above the Bollinger Band or below the Bollinger Band. I have filters that are scanning for number of up days in a row and down days in a row. So you can build filters where it says, I want to see patterns that are holding that prior bar lows pattern or the prior bar highs. So I'm 1,000,000% scanning that. I'm always looking at the most in place stocks, and I'm always trying to move to where the best setups are. Never do I wake up saying, oh, I'm going to trade A, B, and C today. I wake up with the mindset of I'm going to trade whatever's offering the best opportunity.
I love that. Lance, I'm sure there's plenty more that we can go into, and hopefully we can have you back on Chart Fanatics. But thank you for going through all of this with us today. And everyone at home, drop a comment with your biggest takeaway from this episode. Any questions you have, throw them in the comment section below as well. As always, you'll find links for Lance in the description below, so make sure you check those out. And other episodes are on screen right now, so check those out. Also,
Interesting.
hit like, hit subscribe. And this has been Chart Fanatics.
I mean,
Until next time.
I don't know. What do we rate that video? I don't know. I think from the perspective of somebody that is like not an experienced trader, probably a good video, right? Like kind of gave a bit more context to like the concept of a trade itself. Like the fundamental concept of it. And the strategy is I mean, typical mean reversion stuff, I suppose. How you choose to measure that reversion is up to you. $11.20. Do we watch one more of these, or at least start one? I'm falling asleep. I'm so tired. Thing is, I don't want to watch this right now. It's too long. I already know what this guy's going on. An hour, sure.
It is the story of $27,000 to now over $50 million. This year alone, he's shared on X a $7 million trade.
This
plus
is
$10
Ducks,
million
yeah?
trade.
And that trade I made about 1.5 million just in 15 minutes. So short selling has to be very precise, or you're taking huge amount of risk and potentially lose more than 100%. If
Yeah.
you don't avoid, first red day will become first losing day.
Because he has made $15 million from just $27,000. Introducing Stephen Ducks.
This process is very important because once you have simulated how much money you can make end of the year, when you are trading every day, it eliminates your emotion from being FOMO. Because
In this episode, Stephen breaks down the exact statistics that he has built around 3 of his trading models. He shares those exact models with us step by step so that you can implement them into your own trading.
this is where back in the days I was trying to dig how to really precisely capture the top. I have sectioned initial market cap. So you kind of have to look into other people's mindsets, the larger players, because it's much larger market cap. Ideally that for hedge funds, you do not want to push more than
Stephen then shares exact trade examples using this methodology that has made him tens of millions of dollars in 2025 alone.
If you want to be consistent profitable, test the strategy by yourself first. Make sure that whenever you are designing a strategy, it's fundamentally tied to either.
Welcome everyone back to Chart Fanatics, the go-to channel for all of the very best strategy and concept breakdowns in the world with some of the very best traders in the world as well. Talking of which, we have a phenomenal trader. We had him on Words of Wisdom earlier this year, and we were very blessed to do so, and the episode did absolutely incredibly. YouTube even tried to hinder our progress because of how great the results are. It is the story of $27,000 to now over $50 million. This year alone, he shared on X anyway, a $7 million trade, a close to $10 million trade. You already know who it is because there's not many traders who can do such a performance. It's the one and only Stephen Ducks. Hello, guys. Thanks for being here, Stephen. Honestly, it's a true honor to have you back, and I've been super excited all year to get you here on Chart Fanatics. And today we're going to go through some
These
strategies
people
of
are
yours.
funny.
And yeah, I guess just hand it straight over to you. Where should we begin?
Okay, all right. So today I would like to cover maybe about 2 to 3 because some of the concepts are combined. I will start the approach of how I really build my strategy and why fundamentally it works. And yeah, then let's get started.
Perfect.
All right, guys. So the first strategy will be gap up.
Here's what it is. I'm familiar with this guy, but can't say I necessarily remember like his style of trading. Or if he's just kind of does like the same shit as
Strategy will
everybody
be
else.
Bounce short. Third strategy, gap up short. Second strategy will be bounce short. Third strategy, it's what people commonly call the first red day. But this strategy is very strict in terms of criteria. So to be able to increase its winning percentage, you have to really be selective. And there's many situations that it won't work. So I will approach it by statistics, volume, and also share price matter as well. So all those strategies only works on small caps. So let's start with the very first criteria, the initial market cap has to be between 1 to 100 million. This is the market cap. Second criteria will be the float. The float has to be anywhere between 1 million to 50 million. Now there's specific sections between it. 1 million to 2 million is considered to be very low float. 2 million to 5 million is considered to be mid float. Now 5 million to 10 million considered to be large float. Now typically when we're running to something around 10 million to 20 million, we don't run into these type of play that much. So, but the strategy also works as well. So let's start with the very first gap up short. The reason why we call it gap up short is in the morning we see a stock typically gaps over 100%, 70%, sometimes even 1000%. So the very first thing you want to approach is select by the market cap. If the market cap is over 200 million, then it's not doable. It has to be under 100 million market cap. The second one, look at the float. If the float is over 50 million, majority of the time, 99% of the time, it's not really tradable. So make sure to filter that one out as well. The third,
By 50? Like, ever since he started talking about this number, like I've immediately, so I'm looking up on my laptop right now because I'm curious how much daily volume these things have. Because like this cannot be scalable at all, right? If the company itself market cap is $1 million, how much daily volume does it have? Like, like imagine I'm putting on like trying to put on like a fucking $10 million position. Yeah. You can.
one, the 100%, 70%, sometimes. So let's start with the very first gap up short. The reason why we call it gap up short is in the morning, we see a stock typically gaps over 100%, 70%, sometimes even 1000%. So the very first thing you want to approach is select by the market cap. If the market cap is over 200 million, then it's not doable. It has to be under 100 million market cap. The second one, look at the float. If the float is over 50 million, majority of the time, 99% of the time, it's not really tradable. So make sure to filter that one out as well. The third, and then we have to take a look at the volume. So whenever there's volume sections, so it's between 1 to 10 million and 10 to 20 million. 20 million to 40 million is still tradable. When pre-market volume exceeds over 50 million, that's where you have to pay attention, because if in the pre-market trades over 50 million, that means after market open, we're going to trade more volume because people are interested. Then the typical ratio is around 1 to 5 to 1 to 10. So if the pre-market volume trades around 50 million, you are estimating the entire day volume trades around 500 million. So if 500 million is going to be really crowded into a market cap is only under 100 million, you know it's going to be very difficult. There's going to be a lot of algos playing games, and it's very difficult to for a short strategy to work. Now, majority of the time, volume concentrates between 9:30 after market open to 11:30. So if we see a mass consolidations, maybe there is a way to short in the afternoon because volume dies out, and most of the volume that people traded are in the morning. Soon as something cracks, there's more people are stuck on the top, and it will cause a chain reaction for stock to drop. So this is something to pay attention. Then the third thing is we have to pay attention to, this is when the market, before market opens. So we have to pay attention to its sectors. There's 3 sectors. There's about 2 sectors you cannot trade. First of all is biotechs. Biotechs is very different. I have tracked countless of statistics by using gap up short to treat biotechs. The winning percentage drops by about 20 to 30%. So that's something I tend to avoid. Every time when I see a gap up short on the scanner, I delete that. I don't want to see it because I've traded. Now,
I'm curious on the exact intricacies of his strategy, but like, just making it difficult on yourself, right? Basically, if you're doing this, you're trading some unscalable, high risk strategy.
Years have probably traded about 300 to 500 tickers. The net profit of biotech is probably maybe around 1 to 2 million. 500 tickers. So it takes a lot of mental energy. It's just not worth it. So it's biotech. It messes with the winning percentage. The second one is the energy sector.
Okay.
Make sure
Especially because like the gap up probability in this shit, like gap lower, especially even like intraday, is fucking very high. Like not only are you just already taking on this like crazy risk in terms of like the percentage move it's gonna have, 2, you can't scale in any size into this. 3, now you have to worry about the gapping as well.
Those 2 are very important. That doesn't work on gap up short, bounce short, and ideally first red day. So now if it's really
Because all three of these,
yep,
you would look to avoid.
If it's really overextended, let's say something goes up to from 1 to 1,000. Now maybe that's something to consider, but majority of the time on something around 200-300%, maybe even under 500%. Avoid it. And oh, there's another one I forgot about. The Chinese stocks.
Okay.
This one you have to tend to avoid because whenever on the intraday volume, if you trade less than 30 million, I've seen tickers get halted and it's really thin. The volume on the level 2 seem really thin. And as soon as you get halted, I've seen tickers go from 2 to 200 and there's no way for people to get out and people are taking significant amount of losses on it. I personally took about
Yeah, it's funny you said that because like I've seen so many people bitching about this shit. You know what's fucking hilarious about this? That I talked about this so long ago on stream at one point when we were talking about just fucking getting a group of people that have a shit ton of money and just fucking all of you are trading the same thing together, right? That's literally what's happening with these Chinese stocks he's referring to. There's like this huge, like essentially whales come in and they just pump these things out of fucking nowhere when people are in the shorts. And they have massive gap ups. I think this year there was like a 3,000% gap up one day or something.
maybe 5 in the course of my lifetime and a trading lifetime, and it's not pleasant. So I have managed to avoid from going from 2 to 200, but I have taken maybe from 20 to 30. I mean, like 100% loss because there's no way to get out.
Trading education is completely
I need to get some more
broken
water.
for years.
Oh, damn. God damn. This thing's just been sitting here the whole time, just fucking around. God damn. Curious to see if we end up getting any volatility or not. Or not.
The industry has been purged and poisoned by bad actors, fake results, and strategies hidden behind paywalls. But in every industry, every once in a while becomes a catalyst, a moment in time for change. Now imagine a world where elite trading education was entirely free. Education with no hidden agenda, verified trading results, and real profitable strategies, all for free. Welcome to Chart Academy. Chart Academy is the world's first all-in-one platform for trading education. Chart Academy is free.
What is this
No
guy
fees,
yapping
no
on
upsells,
about?
No strings. Welcome to Trader. Browse the and your goal. Just stop, change,
into putting in the creating the
forever.
you mentioned in terms of statistics, just in terms of like creating this criteria. How does that look for you? Is that like an automated process of collecting statistics, or are you essentially putting in the criteria of market cap and the float and the volume, and then looking at the particular tickers and setups and then seeing how they performed, and then creating like the win percentage and seeing what works, what doesn't?
It's not automated. I have tracked down by hand pretty much
Wow.
starting from 2015. So it's almost 10 years. And every day when I see something, I'll put it in my spreadsheets.
Mhm.
And because for its market cap, float, pushing percentages, volume on the day, and also selecting them by sectors. After countless amount of hours, I have figured out a criteria of how to really approach to the best gap up short.
And this is what allows you to. So just to be clear then as well, these rules that we're covering here, is this just for the gap up short, or is this across all three?
Across all three.
Okay, perfect.
So first, except for this one can first red day market cap can go above up to 200 million.
Gotcha.
Over the night, it's probably not ideal. Okay, so the second thing, just in terms of statistics, the reason why I'm giving you this criteria and how I really approach to the statistics. First of all, I track the frequency of how many times they happen per year. So the gap up short happens after taking out all those biotech, energy, China play. There's about 50 times a year, 50 to 70 times happens a year.
Gotcha.
The winning percentage is about 75% or plus, sometimes even higher. Then I track down the reward. What's their average fading percentage? So if I'm shorting, the average goes down about 26% from the intraday high. So I'm calculating the reward So the very first one is I know how many times they happen per year.
Mhm.
I know what's my winning percentage. So if let's say average happens around
Like, is it
70,
isn't
so
it me?
70
Is
times a
it
year, I'm
just
winning about
fucking
close
me?
to-
Like, I don't know. I feel like this is such like I don't know. Just like going this in depth about like the exact stats of the strategy to me just seems like it's just a waste of time, right? Like not necessarily a waste of time. Like I'm trying to think of a way to like articulate this properly, but like I don't like me personally. I don't like. I couldn't even tell you these stats right now. 'Cause what's the point of me tracking it? Like I know what I'm looking for, and when I come, I take it, and that's it, right? And we know what we're looking for. So like, do I really care about the variance of like? Sometimes it works 5% more on average than not. Like either way, like you kind of just kind of know the effective value. Like you know the EV in your head, right? That's like basically what I'm getting at. Like, probably the best way to articulate it. Probably the best way to articulate it. Like you just have it. You know this from seeing it. Your experience.
to 50.
Bum.
50 of them.
I would say like that like do like if you're algorithmic trading, then like yeah, do that, right? But if you're like a discretionary trader, you should be at a point where eventually like you don't need to sit there and be doing that.
On the year.
Gotcha.
And each year, and each sample, I'm winning
Like you already have your system, and you're making just like very small, slight refinement, if any.
26%.
Okay.
So I will know that how much money I'm going to make throughout the end of the year. Now this process is very important because once you have simulated how much money you can make end of the year, when you are trading every day, it eliminates your emotion from being FOMO because you know, okay, well I just wait for the year. This is how much money I'm happy to make. And
Is this what you were saying in the podcast when you were saying what you do is you compare to what your the perfect result should be?
Yeah.
And as long as you're trying to get close to that or you're on track, that's all that matters.
Correct. Yes. So there, of course, there's some human error that sometimes ticker goes not the way you think, and you have cut losses, and all of a sudden the stock goes back down again. So you have to try to adapt to the market by using statistics and using both to make sure that you are trying to approach the best statistics possible. So that's the reason how I do it, and it's been working out pretty well.
This data here is the gap short, right?
Yeah. Okay. So now let's go into aftermarket.
You know the other thing that's dumb about this, like doing the stats like this. The gap risk, the volatility that can come from a gap in these is like to account for that is a big deal, because if you get some like crazy gap up, you have to fucking cover that, right? Like that's how people blow their accounts is because of this, because they get gapped up on so hard they still have no margin. So like sure, 75% win rate strategy with like what, like a 2%, 3% chance that one day your account just blows up. I don't know. I mean, obviously you can like circumvent that by just like not ever doing like huge positions in this style of trading, but like even then you don't want to take a massive loss compared to what you're expecting.
Have filtered out the float, market cap, volume, and sectors. It's going to aftermarket open. So first of all, we want to know that how much volume traded in the pre-market. So let's say assume today you traded 10 million shares in the pre-market, and I'm estimating today is going to trade between 50 million shares to 100 million shares throughout the day. Now, by statistics, majority of the volume concentrates between 9:30 to 11:30, and almost about 30 to 35% of the volume on the day trades before 11. So volume concentrates in a very short period of time, and after 11, volume tends to get slow. And we want to have as much as emotional trades in the morning for other people, of course. So we want to track down the average pushing percentage. So after market open, usually when stock becomes really hot, there's people wants to chase right at the open. Of course, we're going to cover the historical chart, but we're only focused on intraday here. So ideally, we want to look between 20% pushing percentage to 35% pushing percentage. Now, the higher the percent, the better the winning percentage is. And now here we have to separate them by float. So typically, when we're running into between 1 million to 2 million, the average percentage, the percent of pushing percentage becomes much higher because it's low flow and high demand, of course, pushes the stock much higher. So I've tracked down between 1 to 2 million, average pushing percentage is between 30% to 35%. After that, the stock tends to consolidate. Once they consolidate for 1 hour, that's where I typically start to size in. And between about 10 to 11, the stock shows the first weaknesses on the breakdown. That's where I add a full position, risking this consolidation.
Okay, so your risk will be, your stop loss will be built that
I don't like
correct?
this. I don't like this, honestly, because like the more I think about this, like, I don't know. This is not scalable. This is not fucking scalable, right? Like that's and not only that, but like the way he just described it, like, let's just suppose that there are people who are looking at the level 2 data and whatnot, and they see that somebody just did what you described.
That's where I typically start to size in.
This. So it's been consolidating, and he started sizing in for the breakdown before the breakdown. Okay, now let's suppose someone or some entity is watching this, and the level 2 data is seeing that these asks just getting filled repeatedly, holding the price in the consolidation. And then it's like they know that there's a potential for another squeeze upwards. So that if they start pushing it up, then then everyone in this whole thing is now trapped. I don't know.
Between about 10 to 11, the stock shows the first weaknesses on the breakdown. That's where I add a full position, risking this consolidation.
Okay, so your risk will be, your stop loss will be built that high.
Correct. So now, if you are running into something between 5 to 10 million and you pushed about 20% to 25%, that's in the average. Then, of course, using the same method, wait until 11, start a partial position, and after the momentum shifts, maybe cracks about 5% to 3%, size in, full position, risk the consolidation. The average risk on the trade is around 7%. The average fading percentage is around 26%. Of course, you're sizing a little bit below, so you're looking at 25% to 24%. So your risk reward is between 1 to 4. No, 1 to 3.5. Here we go. Yeah.
So you're looking at entry here for the full size position.
Correct.
And stop loss above the consolidation.
Consolidations, yes.
And then in terms of the criteria, is there a particular percentage on the way up, the upside that you want to see?
Oh, yes. The gap up short, I forgot about covering this. It has to be above 100%.
Gotcha. Okay.
Yeah.
So above 100%, you want to see that spike in the market open, see that volume as well.
Yeah.
And then you want to see it consolidate. And once you start to see that first initial breakdown after that consolidation is where you can then look to enter your position, stop loss above the high. And then you're looking for a breakdown of 20 to 35%.
Correct. And the volume has to be matched as well. So let's say the pre-market volume is 10 million. I'm estimating 100 million throughout the day.
Gotcha.
And before 11, you traded 30% of the estimated volume.
Okay, gotcha.
So all the criteria has to line up together for me to take entry.
Gotcha. Perfect. So that's the gap up short.
Interesting.
Yes.
And then next we have, is it bounce short, is it?
Yes. Next is bounce short. Yes.
Futures traders, it's time to hear about Apex Trader Funding, the largest futures firm in the industry. They have completely changed the game with their new evaluation. So far, they've already paid out over $600 million to traders around the world, just like me and you. And not only that, Apex actually holds the record $5 million apart. Stream rule today. No, as I mentioned, so you make on
And specifics in terms of why we need each of these.
I'm also curious when this was recorded. Because they changed the PDT rules, so I'm curious how it impacts this low cap stuff. I can't imagine it's a huge difference, but I am curious. I don't really follow it, so
these criteria to then create a higher probable trade.
Correct.
And you see that. Would you say a lot of traders miss that element of actually working out, okay, how if this criteria is adjusted, let's say the float or the market cap, instead of it being 1 to 5, it's 10 to 20, and how that then changes the result of the trade or the probability of a trade? Do you think a lot of traders just kind of
I
skip
think
a lot of that?
they really miss that specific because it's all about trading is all about supply and demand. Now, if there's lower flow, higher volume, of course the stock's going to push much higher. Now, if you're shorting at the average 25%, you are missing that extra 10%. Of course, you're going to get shaked out and potentially take a loss. So it's very you have to be really strict on the criteria and to prevent from you to make mistakes like that.
Gotcha.
And really screw with the performance.
So then bounce short, where does that? How does that differ than to the gap short?
Okay, so the bounce short, first of all, I want to explain the psychology behind bounce short. To be able to trade bounce short, we typically have to look at the long-term chart. So first of all, we want to go back in 1 year. The chart ideally that we want to see is individual candles that creates massive amount of resistance. So ideally, something like flat. Then we had one spike, and the volume bar probably trades, let's say 30 million. Price $5. Yeah, I forgot to cover the price. All of those tickers, the price has to be over $3. If it's not over
Has to be over
$3,
$3,
it becomes very difficult. It also messes with the statistics as well.
Okay, so $3 price for all three. Yeah.
Now, the reason why the bounce short works is, okay, so after this day, after the big spike into 5 from maybe $1, it drops all the way down and stay flat for 2 months, ideally. Then all of a sudden, we see a gap up short.
Okay.
That gapped over 100%. Let's say gap from 2 to 4.5.
Gotcha.
When we run into this type of situation, is first of all, we know that we traded 30 million volume on this one candle, and we dumped after the day after. So majority of the volume is stuck around $5. And it's been 2 months, everybody's stuck, they want to get out. As soon as they see a gap up short, a gapped up, they want to exit as soon as the market opens. So it will create that massive selling pressure just based on human psychology because they want to break it even. They're down 70%, all of a sudden they're up close to even. The majority of people are up. Your first reaction by human psychology is to sell.
Yeah.
So once you sell, you create a selling pressure. And I'm opening up a short position at open. So I'm riding your selling pressure all the way down. And that's the pattern based on human psychology. So first of all, there's still criteria in there. The very first one is in terms of dollar amount. So basically we use the bottom 30 million times the price.
I'm so tired,
The most
goddamn.
consolidated price. So let's go, after we look at the 1 year chart, we find this candle, we go into the intraday chart. We want to see something like it gapped up, it consolidated for a while, and dropped. So now the average consolidation price is at $5.
Okay.
Then we want to, if you want to go into a very precise way, is you basically calculate all of the volume combined together because some of the volume traded at under 5. So you want to go into maybe a 1 hour chart or 30-minute chart to combine all those volume at the bottom. So you know maybe at the $5 area, you traded 25 million shares.
Okay.
Now, once you know there's about 25 to 28 million shares traded around $5, now you use the 25 million times 5. So you're looking at maybe 120 million, $110 million block. So it's how much dollar is being blocked at $5.
Okay. Gotcha.
Now, if you after that you go into intraday. First of all, you take a look at the volume estimate. So take a look at the pre-market volume. Let's say if they traded around 3 million, you're estimating that not by regular standard, you're estimating times 10 throughout the entire day, so 30 million throughout the day. But something you have to keep in mind is you know that there's going to be selling pressure at open, and you short. So typically stock opens up and plummets 15 to 20%. So somebody are looking to long at open. When they see stock plummets 15, 20%, they're not likely to buy.
Yeah.
So the volume estimate will significantly reduce. It reduce sometimes up to 50 to 80%. So you're looking at 30 million, it reduces to 10, 15 million. And 10 to 15 million amount of shares, so 10 million to 15 million, cannot compete with the 25 million.
Yeah.
25 million volume that's stuck at 5. So the ratio becomes 2 to 1. So in terms of volume, ideally, rough estimate 2 to 1. And that significantly increases the bounce short winning percentage. So this is typical way I take a look at how much volume and is driven and on intraday and to calculate winning percentage. The ratio is very important. The higher the ratio is, the more I will size in. So
Okay, I understand.
if it's 1 to 1, I will reduce size. 2 to 1 increase size up to, I have seen 10 to 1. So
10 to 1.
yeah, I've seen, there's one example at GME. The volume estimate is almost 10 to 1.
Wow.
And that opens. As soon as it opens, instant crashes 50%.
Interesting.
And
An
actually, I made
interesting thing
also
to
very
track.
early in the days. So I made about 1.5 million. So
Wow.
just in that 15 minutes.
Wow, yeah, that's crazy. But it's all based off the fact that, because you said it in the podcast as well, like you really center a lot of your strategies, yes, statistics and data, but human psychology.
Correct.
So in this case, it's really is kind of the combination of how the statistics reflect the human psychology.
You have to combine to increase your winning
So when you see this ratio increase, it's essentially that emotional element is increasing with
Correct.
it.
Yes.
So then therefore you have more conviction because you know there's going to be max pain, if you will, which then
Yes.
creates a lot of time max pain is reflected by a very fast volatile move.
Correct. Yes. So one thing to keep in mind is the dollar block has to be 150 million plus to be ideal. Now sometimes you get to 130, 140. I mean it's doable, but ideally you want to get to 150 million.
And then in terms of the criteria to enter here, so that this is taking place, is the entry looking around here?
Now the entry really depends on the open price. The closer you're getting to the consolidations, the more size you can get in.
Okay.
Because there's less risk.
Yeah. So this is almost similar to a gap short, but it has to have this criteria prior to it.
Correct. Yes.
36 seconds. That's Hola Prime's fastest payout on record. Not 36 hours, not 36
That
days.
always has some
Yeah,
new
there's
thing.
about a couple different variations on bound short. There is if it gapped in close to 5 without much volume being traded in the pre-market, let's say 3 million, maybe 5 million, it increases the winning percentage by statistics. Now, if it's spiking from the very bottom, so after market open, the stock did not move in the pre-market, so it slowly goes up per block to 5 and comes back down. This is type. Let's say this is type 1.
Okay.
It's type 2. Type 2 winning percentage is much higher than the type 1 winning percentage is much higher than type 2.
Okay.
So it's just little bit.
So in this one, it might take the high and then still collapse.
You will approach to the high
Okay.
and collapse.
Got you.
So now the variation on the fading is a little bit different as well. When you run into a gap into 5, majority of the time you see straight down.
Okay.
If you run into something that volume building from the bottom goes up, you're likely to see a bounce, then fade back down.
Okay.
And the fading percentage is also different. This one fades. Let's say the total gain is from here to here. It fades about 75%. This is the 75% from the very top.
Okay.
This one ideally only fades about 50% from the top. So if you count the range, cuts in half, that's the 50%. That's
Gotcha.
the max reward. This is the max reward.
So in terms of a bound short, how often or what's the frequency like per year?
It's the winning percentage is much higher than gap up short. It's about 80 to 85%. It happens around 30 times a year.
Yeah. So 30 times a year, and then 80 to 85
Correct.
win rate.
Also, there's a specific sizing rules.
Okay.
Ideally, you do not want to exceed 10% of the float.
Mhm.
Also, 1% of the volume. So
Yeah.
make sure that you keep that in mind. If you size in too much, especially on a low flow,
10% of the float.
you are likely to break the supply and demand chain, and it becomes very difficult. So,
Yeah.
because I have grown my account to much significant size and have run into this type of problem, that if I size in too much, I'm breaking the pattern. So the problem is you want to size it into a specific threshold, and now back in the days, the stock, let's say the stock goes to 4.5, touching the resistance at 5, it goes straight down to 2. Majority of the time, I just wait until the close to cover at 2. But if you are using significant size, let's say you're shorting 500k shares, 300k shares, you want to cover along the way. You want to give the supply back
Okay.
for people to react.
Mhm.
So it's different.
You have to start playing a different game at the
Correct.
high levels. Yeah. That's incredible. And again, seeing the statistics, and it's really great to see, because this is the amazing thing I love about this channel in particular, is that we get to have the conversation.
Thing is, there's no solution to that. There's no, maybe you have one option. You can limit your size, or you stop doing this. That's the only option.
But then, now to see the actual visualization of, when you were talking about statistics and also the human psychology, now we can see that bridge and that connection in real time.
Like if you're putting limits on the market cap,
And we're going to see the actual trade examples as well. But just before we do that, we have the first red day setup. So would you say your first red day setup in terms of rules, is it slightly different to what you've seen out there already?
Correct. Yes. First red day, basically you are running into much bigger competitions. Especially this year, for example, just happened.
and the thing about this too is like, this doesn't make sense, right? Like, is it not a tad bit ironic that as traders, we don't see the trade-off here? You're taking on more risk for less money trading this way. And the risk of ruin from like the giga gap up is like always looming, always looming in the background. So, yeah.
A very natural developed first red day was the BYND chart.
Beyond meat, yeah.
That one is it's a very standard first red day to talk about.
Mhm.
So first red day, there's a lot criteria. So first of all, it's not just first red day. There's a lot of preconditions, and there's a lot of criteria you have to avoid. If you don't avoid, the first red day will become first losing day. So I have traded many first red day. There's about 3 things you pay attention to. First of all is estimated volume. This estimated volume is very different than gap up short and bound short. I'll cover that later. And there's also a dollar block. There's also intraday fluctuate range.
Okay.
So let's go into the very first of how you really spot first red day, how you really consider it something that's a first red day. And because if you don't qualify a first red day, the reward, the entry and exit becomes really messy, and it's hard to make a profit from. So the very first thing is your initial market cap can range over than 100 million. Typically, we want something that's under 200 million. So before, if you see something that's going from 1 to 10 and the market cap went from, it's already 600 billion, but you want to divide by 10 because it went from 1 to 10. So the initial market cap is say 500 million, and right now, then divide by 10. The initial market cap is 50 million.
Got you. Okay.
So ideally, initial market cap has to be under 200 million. The first criteria you want to go into is consecutive green candles with higher volume, either identical or higher volume.
Okay.
There cannot be a red day or a flat day in the middle. It has to, you see emotional chasing going up day by day, volume higher by previous day. At very least, 3 consecutive candles with volume increasing, consistently increasing.
Do you need that volume for those 3 consecutive days to increase?
Correct.
Okay.
Also, you need the range as well. So typically, if you only see 2 days, there's exceptions for 2 days. This is where I made the DWAC trade. It only went up for 2 days, but the range has to be much higher. So the range creates for 3 days minimum has to be 300%. For 2 days has to be 1,000%.
Wow.
So you can see it's
Significant, yeah.
yeah, very different.
Would you still, even with this one, you want to see obviously the volume increase on the second day?
Correct. Yes.
Oh my
Which would naturally happen
gosh.
if it's doing 1,000, right?
Yes. So if you see, like, let's say a red day stuck in between, and the 3-day resets. So
Okay.
the resets starting from here.
Okay.
1, 2,
You see
3.
another 3 days, yeah.
Yep.
With that volume again?
Yeah, it has to be volume. If it gets another red day,
Resets
it resets again.
Okay,
So,
got you.
so you can see sometimes you run into multi-day runners and you say, why it doesn't work? Because it's up for so long, and the stock went from 2 to 28, and you still got room to go.
Thing
up
about
to
this
100
video
because
is
you have
like,
red
you
day in
know,
between resets. It's emotion.
the main reason I watch these is like, 1, is there some strategy that seems interesting, worth using or improving upon somehow? And 2, like, are they using any interesting data? But there's no shot I'll ever be doing this low cap stuff. At least not at this point.
For people
That rebalancing, yeah.
Yes. So now assume that you don't have the red day in between. First of all, when you run into
But it is
something like
interesting
this,
scanning, I
said the minimum
suppose.
is 300%. But how do I really try to capture the top? Because once it goes to 300%, it might go to 500%, 600%. If you don't time it right, of course, you're going to get squeezed, and to take short selling has to be very precise, or you're taking
A huge amount of risk.
Yeah, huge amount of risk and potentially lose more than 100%. So this is where I was, back in the days, I was trying to dig how to really precisely capture the top. I have sectioned for initial market cap. So you kind of have to look into other people's mindset for the larger players, because it's much larger market cap. Ideally, that for hedge funds, you do not want to push more than 30% of the entire market cap, or in entire float. If you push more than that, you are basically playing with yourself. You're pumping and dumping by yourself. You're not going to make money. So you want the retail to participate into the trade to basically transfer their money into your wallet. It's a very simple explanation. So now, if you can only size in maybe less than 30%, there's a problem. There's only how much dollar retail can pour in, and there's no more money being poured into this ticker.
Yeah.
As soon as that exhausts, then stock crashes 50 to even 75%. Typically, the first green day, it was initiated either by a very beaten down chart that's squeezing the shorts and retail start chasing back in, or it's something that a big hedge fund starting by a huge chunk of the float starting there as well. In terms of the chart, there's a little bit difference as well. So if you're looking at a long-term chart, if the chart is keep trending down, and all of a sudden you have 1, 2, 3, those multi-day runners then qualifies the first red day. These type of chart tends to go up a lot more compared to the average long-term chart that is flat than 1, 2, 3 as multi-day runner. So keep that in mind. Then let's go into how to really capture the top. The first of all is pay attention to, as I said, the initial market cap. If the initial market cap is, let's say section is under.
He didn't even explain it. Like, But yeah, anyways, this fucking like when it's coming when price is coming down like this, like in a structured manner, like give me like a prolonged squeeze, right? Whereas this is like they gapped up, everyone's closing out, and then it just reverts right back down. So yeah, these ones can definitely go on for like for a long period of time.
Now you want to, let's say you don't know how to trade first red day, you want to get to know that. How do you really, you want to section all of the multi-day owners and calculate at what type of volume they trade on consolidations and then starting to drop on that very tip. So you can calculate what's the dollar amount being traded at the very top.
Yeah.
And have tracked them all together. I have hundreds of samples. I found that pretty much the same market cap, initial market cap, rounds up all the way up, and they all, even though their market cap and flow has to be under the same section, but the price is different. So, but pretty much all of those multi-day runners now qualify first red day. If they're within the same initial market cap, they all stop at the same dollar amount.
Really?
So, very similar. So either if it's initial market cap, they stop at one. Once they trade, let's say $200 million at 200 million shares at $5, trades 1 billion, stock starts to go down. If the initial market cap is 100 million, it trades 3 billion, stock tends to go down. Starting at 200 million, it trades at maybe 5 billion to 10 billion, stock tends to go down. And you want to section them by their initial market cap. So if ticker starts at, let's say, IPO at 500 million, so IPO is a little bit different.
Yeah.
And their dollar block starts around 30 billion. So then it starts to go down. Now this one applied to CRCL that happened this year. So that's something that you want to look at. And now how to really predict when it's coming, and also to prepare yourself, because I've run into a situation that I keep taking losses on the way up and I'm making profit on the way down. Basically, I'm neutralizing my losses and wins. So you want to avoid not to take losses on the way up. This is where that you want to track down the average volume increasing. So ideally, let's say it starts at 50 million shares at the very bottom for this one candle. Then the next day it goes up to 70 million because the volume has to continue to increase. The next day it goes up to maybe 100 million to 120 million. So now on the fourth, there's a possible chance that can go up to 150 million to 200 million.
I've got to tell you something. Hundreds of thousands of traders have already made the switch to trade Zealot. And the biggest reason, the autopilot. Patterns you trade tick by up wheel every decision. Now, if you
once I figure out the initial market cap and I know the dollar block, I can calculate. So basically, the first of all, let's say started at $5. Now, if I'm trading something that's much larger market caps, I know that in average on the daily.
I would hate to be trading like this, honestly. I have to sit here and like just track them with like data for all of this, and I have to like test all different variations.
10 to 50%. So I kind of know that in the next day maybe trades around 8 to 12, the next day trades around about 12 to 18, and next day trades about 25 to 30. So on the second day, I'm already looking at the chart. So okay, what day is likely to reach its maximum dollar amount before it drops?
Yeah.
So I'm calculating maybe on the pre-market, I'm looking at it. Okay, today's volume estimate, it's pre-market times 10. It's gonna reach about 100 million at 12. Now the dollar block is 3 billion. So okay, well today's not likely to reach that. So I'm just gonna don't touch it.
Okay.
And turn off the computer and go into the next day. Now if it's 3 billion, trading around 150 million at 20 to 30%, 20 to 30. This is the day it's likely to reach.
Okay.
Its dollar
So
amount.
this allows you to one step away. You don't have to like just focus and just watch it for no reason.
Yes.
Avoid losses most of all, because again with the first red day, that's the biggest thing. You're trying to almost predict when this is going to turn to get the high risk to reward trade.
Correct.
But in doing so, loads of people just end up, as you say, to take losses.
So many people take losses. I mean, I'm also one of them. Yeah. So and I have to really dig deep into like how to really avoid it on the way out, because first red day you're shorting. Of course, stock can run up 2,000%, 2,000%, but you're shorting. The maximum you can only make is 50%. On a massive crash. So being very, very precise is very important. This way prevents you from taking losses on the way up. And
so did Beyond Meat, did that fit this criteria, or was that slightly different, or did it fit the first red day with these rules?
No, Beyond almost fitted the range.
Okay.
So all of those things has to combine together.
Yep.
It's not just one. It's the various market. It doesn't give you like a textbook.
Of course, yeah. This is I always highlight like this whiteboard thing is like textbook. This is what we're showing as a textbook, and then we go on to the actual reality from the trade examples and stuff. So because it's easy to see this and think, oh, this is easy. It's going to be perfect like this. But yeah, no, it's good to highlight.
It's not as simple, because there's also you need experience of control size.
Yeah.
Control size and control your risk, because as a way I talked about the gap up short and bound short. I also said that based on the winning percentage, you're sizing more. Based on the winning percentage, if it's lower, you're sizing less.
Yeah.
And also the volume ratios, you have to pay attention. let's say the volume ratio is significant, but the price is barely $3. Now, how you're gonna size in smaller because it doesn't really meet the $3 plus criteria. Now, if it's like 2.8, 2.9, barely touches the criteria, you have to kind of size down as well. So there's a lot of experience by controlling size. By pay attention to the little criteria.
So in terms of this, then frequency-wise, what was the frequency of the first red day?
The frequency of first red day happens between 5 to 10 times a year, but this one doesn't have a size limit. So you can, if your account is big, you can really grow your account by only focus on the.
This is like low key harmful, right? Like, if you just started trading, would you really want to be trading like this, or like this is like learning how you'd want to trade? Like compare the last video we just watched. Watching as someone that doesn't know how to trade, and then compared it to like watching this video as someone who wouldn't know how to trade. They're probably sitting there like, what the fuck? Like all like the extra contextual information you need to know to be doing this.
Those first red day. For gap up short and bound short, typically now there's exceptions, and other than like GME, AMC, those hyped up tickers, that only happens maybe 2 to 3 times a year. Average gap up short and bound short, the maximum size I personally have touched is around 1 million to 1.2 million.
Wow.
So your average weighing on each of those tickers is probably 200K to 300K max.
Yeah.
On first red day, then you can make up to millions, even billions. So
well, that first red day for you had on the Beyond Meat, that was a $7 million trade.
Yeah, yes, that I think I could really push it to maybe 13 to 12 to 13 million, but the size has become so big that it's really affecting the ticker. If the trade doesn't really work out, I have to cover my size. I have to take extra, maybe 5% loss, 6% loss because of my size. Yeah.
And that's why, do you feel like that's
the other thing, right? Is like
really
it's not just like the entering,
so that you can really minimize those losses, because if you get trapped in at that sort of size, it's going to be exponential.
It's a disaster. Yes. So the bigger the size is, the more difficult the game becomes.
So. Okay. And in terms of just the
the other thing about it is like, what can happen in this scenario? Like, okay, suppose this guy is trading the way he is with his size, and there is another person, like a clone of him, with the same account size, whatever, trading alongside with him, trading the exact same way. When they realize that they start to lose and they're going to get pushed out, like, the difference in who literally closes the trade first on the exchange impacts the slippage that much more. Just from like the difference of time of one person clicking the most to get out versus the other. It's just, I don't know, man. I don't know.
Before we move on to the chart examples, what would that look like for first red day? How do you look to actually cite, when's the right time? Or
whatever, each to their own, right? Each to their own. People want to trade like this, so be it.
Intraday of the very last day of multi-day runner. So once we have the pre-market, then we consolidate and we have reached the dollar amount right here, 3 billion. Then the first thing I'm looking at is don't rush shorting on the current day, because you can do something like that. I've run into that type of situation before. So you think it's gonna break its dollar block, and suddenly it does a fake out and crashes down. So on the very first day, once it reaches, only sizing maybe 1/4 of your positions. The reason why is momentum doesn't likely to shift when the volume is extremely high. So you're waiting for the second day, because second day tells you the stock is going to drop. Now the reason why is apply into the bound short concept, because in the bound short concept is on the intraday volume, you are not going to compete with the resistance volume. There's more people selling apples than current day buying apples. Now it's the same concept after we go into the second day. Is in the pre-market, the volume trades significantly less. Maybe even, so let's say on this day traded 200 million volume. The pre-market only traded 7 million, or maybe even 5 million. So by volume estimate, you are not going to compete with the 200 million on the previous day. The volume ratio becomes significantly different, becomes 4 to 1 or maybe 3 to 1.
And this is where we're entering the first red day?
I'm so goddamn tired.
This is where we're entering the first red day.
Got you.
Ideally, majority of the time, you're not going to see bounce. So you kind of have to calculate. The reason why we're sizing 1/4 is to bring up your average by sizing in at almost at the open, because ideally you want to size at the bounce because it minimizes your risk, but on the average samples, I don't even see the bounce that happens at the open. So pay attention to this gap, because this is where your risk is by risking the consolidations, and you just write it the way down. Typically, this range is pretty wide, maybe between like 10 to 15%. But winning percentage on this first red day can get up to 90%. So you can really push size, and I have seen some tickers that push into the resistance but still fail. So the winning percentage is extremely.
I don't know, man. I think that's terrible advice too. Like that statement does not apply to low caps. Like high win rate, let me size in. Yeah, I don't know. I would never like. I mean, I don't know what his max size is. I suppose. Suppose that's fair enough.
It's worth the risk.
Yeah. So you put stop loss above the consolidation. If it's had a spike, would you put it above the spike or just still above the consolidation?
Still around the consolidation.
Got you. So here, and then entry wise, you got 1/4 of a position here, and then on the bounce, you look to size in the remaining of the position, which in essence could be around a similar area or just short of that.
Correct. Yes.
Got you.
So for all the new traders out there, I mean, I have grown from new traders from trading for almost 10 years plus now. Make sure that whenever you are designing a strategy, it's fundamentally tied to either human psychology, has to be logically make sense. If somebody give you, let's say, follows the criteria of this one has to meet a certain criteria that doesn't make logically or psychology in sense, and then the strategy is not likely to work. And also, if you want to be consistent, profitable, test the strategy by yourself first. Yeah, that's very important. So in this video, I'm going to cover 3 specific patterns for gap up short, bounce short, and first red day. So I'm going to give an example for each to show you guys what to look for on first red day, gap up short, and bounce short. So let's go over on the first one, first red day. So specifically, you can go first of all, you want to look for some parabolic action. So that the price trend is speeding up and is trading more volume on the previous day. And on the third one, which is very important, is you need a consecutive green days, at least 3 days. So 1, 2, 3, 4, 5. But you can see on this day is red day, so it makes it really difficult to predict the following red day. So for the first red day, it is that you spot the first red day and you short on the second day. So let's say you spot the first red day, you had a 1, 2, 3. So it closed red, but on the day it was green. So that still fits the 3-day consecutive green day candle. Then going to the following day, if it's green, then you do not want to short it. You want to stay away. But if it's red, yes, you can. So for this case, it has 1. And then if it had a red day in between, then it does not count for first red day. It needs to reset for another 3 consecutive green days. So 1 and 2 and 3. So this one closed red, but it was green during the day. So it closed red, and after open, it gapped down. So it's for sure that during the day, it's going to trade in red. And on the following day for silver, this is a very good trade for potential first red day pattern. As long as the first red day doesn't crash over 50% of the entire gain. So in this case, the entire gain starting from $50. If you do a range, this is the whole run up, and you gap down to here. So the 50% is actually here. So there's still about a bunch of reward after the open. So shorting around 92, 93-ish is still doable. Personally, I think I got scarred, but attempting to short one here, probably one here. I wasn't really focused on first red day pattern. So I made 2 mistakes on those 2, so got scarred. If you want to take more losses on silver, then I did not catch this first red day. But this is a classic first red day pattern. So 3 conditions. First of all, look for a parabolic action. Second, look for a 3 consecutive green day that volume has to
Oh my god, that's actually funny. I just spent this whole time talking about how this is. What did you just say?
Second, if you want to take more losses on silver, then I did not catch this first red day. But this is a classic first red day pattern.
This is a quote unquote classic first red day pattern. And then he goes on to say how he fucking got fucking stopped out multiple times, taking it on the way up, and then didn't take it on the way down. Okay, interesting.
So 3 conditions. First of all, look for a parabolic action. Second, look for a 3 consecutive green day that volume has to pass each on the previous day. Now, if you want to go into detail, then you want to you can see the volume is actually decreasing from the previous day, but it's trading a higher price. So the actual dollar traded volume is bigger than the previous day. So the standard is the dollar amount. So the average dollar traded on the day times the volume has to be greater than the volume times the average price traded on the previous day. So that's the 3 conditions for first red day, and also make sure that the range is.
Also, the thing about this is like you have to account, like you can't just look at the volume of just like this, right? Like just futures and whatnot as well.
Suitable for shorting on after the first red day. There's not a specific market cap range because it works on pretty much all market caps, silver, and
interesting.
Ideally, it's much better to predict on small caps. So small caps, 3 consecutive green day with at least 300% range from the initial breakout, then it is doable and also qualifies for the first red day pattern. So that's the example for first red day. Then let's talk about a gap up short. Specific gap up short. There's all different variations of a gap up short. So let's talk about bird first.
Oh, this was that AI pump, right? Like they
Now,
pivoted
one
to
of the reasons
AI.
why gap up short it doesn't have a high winning percentage is a lot of people tend to short on a ticker that's very crowded. So on Bird specifically, this one traded about, I think it's around 70 million shares in the pre-market. There's one condition that if a ticker trades more than 50 million volume before the market open, it is ideally not tradable using gap up short. So majority of the gap up short, if it has strength at open, it will spike up and goes into a consolidation. That's right here. Then you can see it squeeze all the way up. So if the ticker is really crowded and it traded like 50 million shares before market open, and it's ideally going to trade a couple hundred million shares throughout the day. So before 10:30, if you are trading 150 million shares, there's going to be another 150 million shares going to trade after these consolidations. So majority of the time, it tends to not work on the breakouts. So on the shorting the breakdown, sorry. Once the crowded day is over, going to the following day, if it gaps down, the volume will dry up. That's where your shorting opportunity tends to appear. But this is one of the examples you do not want to use gap up short on. This is one of the gap up short pattern. The initial spiking point is $3.
Because you know what the
So-
other thing about this too is like all these stats and like yada yada yada, like 3 candles in a row versus 2, blah blah blah. At the end of the day, if you're watching this thing and it's just, and you see that it's starting to like do the blow off move, whatever chart you may be looking at, like you're gonna see it start to crack on the lower time frame, right? Like, yeah, all these stats are cool and all, but like you're actually trading what's happening in the moment. Like the stats at that point don't matter, right? Like, yes, sure, whatever. More likely for the setup to play out in your favor, but like either way, you're gonna be watching it unfold. A lot of people will take that same trade, like the same chart. Like, yeah, like for instance, a lot of these moving average traders basically they do the exact same setup that he just talked about, exact same. But in terms of like all those stats and whatnot, it's not needed, right? Given like when the preset conditions are set, then you just take the entry when it presents itself. Yeah. Plus, not only that, but when you do it this way, the risk reward is crazy high. Because like think about it. Let's just say I was looking to get into this stock. Like, let's just say that like we'll imagine an imaginary chart, and like let's say that this did not exist. The price was just pumping up. Oh my god, fuck. And price had been like pumping up into this like blow off move right here. Why does this not work? What was I saying? Like as soon as it cracks the BWAP and you enter, like and you put your stop at the high of the day at that point, and you can like take confirmation for this however you want. It's just like one example how you could be doing this. And suppose this is a daily chart referencing one of these moves he's talking about. One of these like massive that moves that end up blowing back down. This is the 5-minute. This ends up being like a huge move on the daily. If it ends up like rolling over. And the RR on them is much higher.
He gapped all the way to 9, and when he spiked up, he pushed through the pre-market consolidations, and he topped out around
What is this guy
12 and
saying?
fade all the way back down. Of course, on the following day, it faded back down again. The only reason why this one didn't fade all the way back to 4 is the flow is too low. So if the volume trades very crowded, if it trades over, it's relative. So it trades 30 million volume. It's already very high for a flow that's around 700K float. Ideally, if float rotates more than 15 times, it is not very ideal. So this is generally crowded, so the reward will get reduced on gap up short. But this is one of the variations in gap up short is EEIQ. If the flow is really low, you want to wait for a clear signal for it to short. Specifically on something that it drops 50% from the top, then it bounces, that's where you short. So in this case,
Oh, we gotta do a juice box still.
there's
Damn.
two method you want to go with this. So first of all, you want to spot the flow. Let's say if it's under 2 million, it's considered to be a very low flow on a nano flow. If it's trading on very dense volume, over 15 times of the flow rotation. after the clear signal of 50% pull on the bounce, this is where you enter. But if the flow is around 5 million or 10 million, you can try to short against the pre-market high, and that's where it tends to top. So there's about two ways I go for a lower float to a higher float. A gap up short, there's a bunch of details that involved based on the float amount. If the flow is is between 3 to 5 million, then you want to size in, but not in full size. If the flow is much higher, let's say 7 to 8 million, then you can size against the pre-market high by using maybe 50%, 60% of your initial position. So it's all based on statistics. How low is the float and how much the volume trades throughout the day, and also the lower the float, the more dangerous it will be, and the lower the float, that if it passes a 1 million threshold or under 2 million threshold, you want to wait for a clear signal that momentum is shifting, then shorting into a bounce. So that's for gap up short. Let's say bounce short. Bounce short is relatively easy. Here is one of the examples for bounce short. So this one went from 2 to 6, trading around 100 million volume, then it tests the previous day high, trading with much less volume, it faded all the way down. So first of all, for bounce short, there's a market cap limitations that ideally works under 200 million market caps, under 50 million float. You want to spot that a single day candle has ideally more than 100 million volume, and also trading into a consolidations. So let's take a look at March 30th. So you can see the consolidation, majority of them landed around 5.6. So going to a bounce short, like if the ticker spikes up, you want to aim for its consolidations as your risk to build your positions, and also make sure that sizing proportionally to not let your risk go off the charts. Then going to the 2 day later, you had a bounce. You can see it tested, it was consolidating around 6 into resistance, so shorting at open, it's not too bad. This is one of the bounce short that happened. It was trading at much less volume, and also you want to do a volume comparison, that the current day volume estimate has to trade much lower compared to the concentrated volume that traded on the first green day. So specifically for gap up short, you can use gap up short as first green day. If it's crowded, then you do not want to use gap up short. You can use that consolidation as a risk to short as a bounce short. So the patterns tends to work out with each other, and helps you to some conditions helps you to avoid big losses on the first green day. Don't trade the crowded tickers on the first green day without resistance. Ideally, if the flow rotates more than 15 times, you want to reduce your size significantly. Other than that, that'll be all of the
the video ends.
Gap up short, bounce short, and first red day. That happens
Interesting.
in 2026. So that'll be all. Thank you.
I love that. Thank you, Stephen. I appreciate that. No better
Honestly,
words to say than after Stephen there. So this
I
is
don't
the Chart
know.
Fanatics.
That
Take it.
video. Didn't do it for me. Did not do it for me. I think it'd be pretty hard to make an objective argument that is just like it's like suboptimal, you know. And we're not even considering the fact that you have to actually be there physically trading it the whole time. Let's not forget that, because that's a big factor, right? Okay. Okay, let's do a juice box and get out of here. I'm tired. I'm like fucking can't even think straight. I was already so tired yesterday. The day before, the last time we streamed, I was so tired that night, and then like I didn't even sleep that well. And yesterday I barely slept. So this is like day 3 of like next to no sleep. So I'm like kind of out of it right now. I'll say that. But where do we leave off with the last juice box? I mean, we were kind of talking about it at the start, honestly. There's really nothing to... And we're going into the weekend. Hmm. I mean, thing is, ideally you're already in the long, right? Ideally you're already in the long. Because like we talked about it earlier, but there's like this zone, right? I think it was around here. Like this is like where the main lower time frame liquidity is. Actually, just kind of look at the liquidations as well, like the higher leverage ones. Out of curiosity. $63. I don't know. This zone's looking pretty juicy, right? The first day that we talked about this, like there is such a massive high leverage liquidation up here. Like abnormally large, looking pretty juicy. Anyways, yeah, to the downside, like there's like this is like the main zone you kind of want to see hold, to be honest. Cause then you start to like lose yesterday's value to low. And in terms of trying to think. Like if this zone doesn't hold, like that's what I'm thinking about right now. That'd be pretty suspicious, to be honest. Like I don't know if I entertain anything but beneath that. Like maybe this point of control down here. But at that point, it kind of just be like what we were talking about the other day of just being potentially just like a bull trap. And it'd be pretty weak to retrace down to these levels. That's the thing. Like we are just like impulsing off the low after closing out all the shorts too, right? So we continue to follow through even after that. And we're like doing like a flag up here. So like, should we be losing the flag for anything more than like a ding ding and go again? Probably not. Because then you're like coming back into this value zone. In which case, like, all the lower stuff is back in play again. Yeah. Also, I mean, obviously it depends how things would be looking on this retrace if you even get it. But like, not the ideal spot to long at this point. Like, this is kind of like a freebie, right? Like anyone that was here at the time looking at this got the ideal entry or like the retrace. Yeah. What's it? The other thing is the upside zone that we were talking about. This like value area high. The other problem is the volume, right? Like it's not like this is like a Monday right now. Like who knows how this could like kind of get really just abnormal given the weekend low volume. If we don't see an increase in volume, we usually do not. Because like, sure, maybe you could like mark it in if we like flip the zone. But like, it might just like. Especially if it's before sweeping the lows. And then to come down, try and put in like a strong buying tail and go again. Tricky. I mean, it's either gonna be one of these two, right? It's either gonna be like trying to flip this level or getting the retest of this level. Yeah. I leave those as the most immediate ones. Like flip. Can't even type. Bullish retest of the PD val. Whoops. The other thing I was thinking of is suppose we open around here when RTH resumes. I'm curious to see how these like gaps play out. And then in this case, like this gap fill and goal at the naked point of control would be like an interesting spot to be potentially watching. Essentially just like retesting this level during the cash session. Along with just seeing how we react around any potential gap in general. Yeah, that's a ways away from now. So either way, whatever. Kind of same story, right? These are not the ideal ways to play this at this point. That's okay though. And for the shorts, I think we talked about everything already at this point. Nothing has really changed from like either A, what was in the Discord, or B, what we talked about last stream. Like we talked about this one, you got the opportunity. We talked about this, you got the opportunity. So these two are kind of like done at this point. But these higher ones, we talked about this one. When was it, Tuesday? And all this higher stuff is on Discord, so I'm just go read that. Yeah. And then from the downside, From the downside, what do we do? I mean, same kind of story though, to be honest. Be honest. Like you had a pretty good opportunity on this move at this point. It's kind of like it gets a bit more awkward. It's like there's a pretty realistic world where they're like, let's just think about this, right? Like let's just suppose you're expecting this to break down and head lower. There's a pretty realistic world where it just does this. So like, not the greatest short. And then like what's the other thing you can do? Like wait for like a bigger pullback. But like again, like this higher time frame zone's like a massive magnet, and you'd be leaving like these like unswept lows, and there's already like liquidity building here too. Or sorry, highs. Higher levels, higher levels, best bet, and second best bet is going to be like some kind of failure happening here on the higher medium time frame. Why is this not working? It keeps cutting out. The fuck was that? Is this like low battery? Odd. We'll kind of just say wait for higher levels we have discussed on oops to coming back into a downside volume node, basically. Like if we lose this, we're probably going to come back down to the other side of the value. Yeah. Anyways. Okay. Yeah, I was just trying to think. I was thinking to myself, oh, did we miss anything? Did we miss anything? Not really, right? Not really. Interesting. Something's wrong with this mouse. I just realized it's not me. What the hell? Okay, good to know. Might have to replace this thing. Yeah, this is a pretty interesting zone up here. This is like what the biggest like cluster is. 618s right here, all the single prints. Just like monthly naked point of controls there too. Interesting zone. Anyways, get ready to wrap this thing up and get out of here. So I think we got this covered between last stream and this stream, and all the Discord stuff for the higher time frame things. I don't think there's too much to really yap about in regards to that. I'm just thinking, I don't know if I'm gonna stream tomorrow. TBD. I suppose we'll see kind of what's happening on here. If there's anything interesting happening, maybe we'll hop on for a bit. I'm trying to go do something. I just haven't confirmed any plans yet. I'm trying to make them, so. Oh. And if anything, maybe like let's suppose something of worth noting, but not worthy of like a full-on stream happens, maybe we'll just kind of post in the Discord. Can't see too much going on. And the weekend we'll go from there. Thing is, it's hard to kind of give times because I am trying to do some shit while I'm here with people. I haven't confirmed a whole lot yet. So hard to say. But we'll squeeze in something. How about that? We'll squeeze in something. But we are out of here. I'm tired. Boy, I'm so tired. Who's the chat? Mr. Harris Kamal. Shut the Harris Kamal. Looks like we want to go higher. Here's to see how this looks tomorrow and going through the weekend. But now we just chill, right? We're already positioned. We're already chilling. Don't gotta worry about nothing at this point. I'm out of here though. Later. I'm so tired.